to auto tariffs any moment now. When I say stupid headlines, the top stories on CNBC today were about Steph Curry launching a new sports streak with Michelle Obama, or GameStop surging because of its desire to buy Bitcoin and add it to its balance sheet. Just a weird Wednesday overall. Stocks here off 1.2% in the S&P 500, 5756. The Nasdaq down 1.87%, 20,105. The Russell off by 1.09%, down at 2,089. Did mention that the bonds here were weaker on the day, not bouncing with the stock market coming off. Data this morning, durable goods, we'll get into. The Richmond Fed manufacturing survey from yesterday is buttressed by a Dallas Fed survey today, in which respondents called this, quote, the worst business environment in my 40 years in the industry, unquote. Gold, silver, ebb and flow, but it's that copper move that draws people's attention. We'll talk about the tariffs and the impact there. Likewise, we'll look at energy, crude oil continuing to squeeze higher, natural gas meandering. While the dollar has a mixed session, it's budget day in the UK. We learn all about what they plan on doing with austerity or austerity light with respect to the welfare state. And I suppose that's the Wednesday news. Ilya, I look at these charts and I see an ugly reversal here against our 1 month moving average with this evening star candlestick pattern coming into play and closes below our 1 week moving average along the way here. That looks pretty darn toppish in a place where the S&P 500 has previously carved out lows. Why are you not looking at this former support turn resistance and thinking that the rally may be finished?
Take a look at the subsequent level of support turned resistance turned support again, immediately underneath where we are currently. So here's last week's consolidation range. And at the very top of it is where we sit currently. Now, obviously, on a 1 hour chart, it looks like we've overshot it, then came back, but that's a 1 hour chart. These things are volatile, so it would be less than wise to overinterpret. But if you look at a 4 hour chart, if you look at an 8 hour chart, most importantly, if you look at it daily, you can see, but even here on a 4 hour, you fall short. You try and you fall short. And on a daily, it's very obvious that what you're doing is you're retesting where you had a breakout just recently. And of course, now the question is, do you fail the breakout or does the breakout hold? And so I am certainly not against this being the end of the rally and this being a reversal. I'm bearish. I want to get back short. But I don't think we have that confirmation here. I think what we have at this point is a stair step higher. And we are on the step. And we're going to find out if we slip and fall or if we decide that we're going to keep climbing. I think we could keep climbing. I think getting back to 5,900 or so to really scratch the underside of the January range, where those lows are in mid-January. I think that's still feasible from here. I would not be surprised if that's what happens here, largely because I think the next big inflection point comes at the end of next week with NFP. These tariff headlines are, of course, not great. We get the news that maybe we get auto tariffs today, as you were saying. I don't think it's surprising, and I don't think that at this point, as of maybe the beginning of last week, I don't think the markets expect that their consternation will meet with anything different, anything sympathetic from the administration, because the administration keeps saying they're not going to change course, no matter what stocks do. Meanwhile, the Fed was, in fact, commiserating with the markets last week. So I think where you end up with is the markets go, well, we're not going to get any help from those guys over there. Really, we need help from these guys over here, that is the Fed. And they're not going to make a call one way or another until they have Chair Powell's apparently beloved hard data, quote unquote. And that's NFP next. mean, maybe we get something crazy from PCE on Friday. I don't think we can discount that wholly, but almost. That's not exactly the world's most market moving indicator recently, in any case. So I think it's NFP next week, and in the meantime, you can have some fuzz, but ultimately, that's the next big inflection point, and the markets can hop themselves up on the Fed will come and save us in the meantime.
Dylan, it feels like it's bizarre world here on Overtime. I'm not feeling great about the stock market. Ilya's feeling optimistic and hopeful that it still has a chance to run higher here.
Not optimistic, just greedy. I want to short at a higher level.
Split the difference between us. You look at today's action, and it's led by tech stocks. It's led by Tesla, for example. This is off nearly 6%. It's had a big week this week, so we're not taking anything away from it. But clearly the imposition of auto tariffs, which, again, waiting to come out any time now, we see here weighing on some of these auto manufacturers. What's your take on the latest twists and turns in the tariff talk?
I mean, I think you always got to be short the tariff. At this point, I'm ready to say short the tariffs every time out. So if anything, I think that the like this auto sell off, that red candle there, or you just showed the Tesla chart or whatever, from a trading standpoint, I'd rather buy them at the open than anything else, because whatever it is, it's mostly hot air and it won't last. It's sort of like this year, I haven't traded it yet. It hasn't, although Amazon, I guess, was a version of that earlier this week. I don't know how that did today. I didn't look, but, not so great. So there's tariff talk. So I guess my theory, or our theory, that Amazon is a tariff proxy is validated by the reversal today on tariff talk. Anyway, I don't want to distract us. I think that tariff sell-offs are buying opportunities. Full stop. I think it's a clown show, full clown show. It's sort of like the Iranian retaliation theater last year with the oil markets, where I feel like this is sort of tariff theater with the new American president.
You do get that sense. I mean, when you look at the thing happening in particular with the USMCA, you get new tariffs on Canada and Mexico. Oh, no. Then all of a sudden, there's a carve out for every good that already is covered by the USMCA. Okay, so what's the message? The message is the USMCA expires next year. If the goods you trade in aren't in the USMCA, they're subject to these tariffs. What are you to do but to broaden the USMCA to more goods? Which, of course, is exactly what the USMCA represented as relative to its predecessor, NAFTA. It just broadened to more things. So is the message here then that it's not that we want less free trade, it's that we want more. We want USMCA to cover more. We want the North American open market sphere to be larger. We're just going to get there with the stick and not the carrot. And you can, of course, argue that this is not the way to go about it for all manner of reasons. But that's a separate argument. The question of intent is, does the administration want more free trade with Mexico and Canada or less? And although their tactics are aggressive, it seems like the messaging is more. And if the answer is more, then you end up with a very different kind of take on things like, for example, auto tariffs that would also include Europe. Does this mean that we want less trade with Europe? Or is this a negotiating tactic, an opening bid to say we want actually more and we need to come to terms? To that end, I think the tariffs themselves maybe aren't the issue. In fact, if we look at global manufacturing PMIs, they've run higher. I mean, March was not great for anyone because it looks like the effects have waned, but January, February, it was all about we need more manufacturing to front run these tariffs. The big impact has been sentiment-based and in services. So it's not the tariffs as such, it's the chaos.
It's the chaos.
And there again, the market looks and says, yeah, well, these guys seem to want more free trade, not less. They seem to be just negotiating in this kind of adversarial mobster kind of way. But the issue isn't that they want tariffs and that they want to negotiate and then this thing will ultimately resolve itself. The issue is businesses completely unrelated to these tariffs are concerned by the optics and holding back capital. And that's a growth scare. Won't the Fed please come give us some cheap money to make it all hurt less?
Which gives you a long bond position, but also a long, like, again, short tariffs by virtue of being long, whatever you want to pick. I was using Amazon, but could be anything, I would imagine. Or not anything, but it could be a lot of things. It's like short term, I'm optimistic that the blow-ups in the market from tariffs are short-lived. But intermediate and longer term, I'm concerned that the total unreliability of the American government will create legitimate retraction in investment and spending and ultimately growth.
Well, that's actually a good segue. Right. That's a good segue to the Dallas Fed manufacturing survey that we got today. The respondent, I have never felt more uncertainty.
Drill, baby, drill in quotes. That's great.
Let's just read through the whole thing. The administration's tariffs immediately increased the cost of our casing and tubing by 25%, even though inventory costs our pipe brokers less. U.S. tubular manufacturers immediately raised their prices to reflect the anticipated tariffs on steel. The threat of $50 oil prices by the administration has caused our firm to reduce its 2025 and 2026 capital expenditures. Drill, baby, drill does not work with $50 per barrel oil. Rigs will get dropped, employment in the oil industry will decrease, and U.S. oil production will decline as it did during COVID-19. I have never felt more uncertain about our business in my entire 40-year-plus career. Uncertainty around everything has sharply risen during the past quarter. Planning for new development is extremely difficult right now due to the uncertainty around steel-based products. Oil prices feel incredibly unstable. It's now hard to gauge whether prices will be in the 50s per barrel or 70s per barrel. Combined, our ability to plan operations for any meaningful amount of time in the future has been severely diminished. Dylan, we know that oil drillers are commie libs, but are these oil drillers down in Texas onto something here about the uncertainty in the business environment?
I mean, I think that's a rhetorical question.
Okay, we can move on then.
I mean, I think the question is not, is this what's happening? This is obviously what's happening.
It's what's happening, yeah.
I think the question is, where will the consequences of this uncertainty manifest and how? And then it's either a matter of speculating about, where the potholes are going to be in the individual names, or maybe it just makes me more sort of a warm up even more to Ilya's long bond position, because it's going to be lower rates sooner in the face of slowing growth or potential recession as a result of this madness.
Again, the market this week was fine with April 2nd being Liberation Day. It's not okay with the market today when we find out that, actually, auto tariffs are getting levied this afternoon, right? We thought we had a clear direction. We thought we had some clarity. Right? We're narrowing the scope of the tariff. So it means they're having that when you say you're narrowing the scope of something in this context, it means, they have a plan. They're kind of dotting their I's and crossing their T's. They're finalizing things. They're looking and they say, okay, this is going to be left out. Let's put that aside. They're getting ready to present the package publicly. And now it's like, well, now auto tariffs are actually back into play and they're sooner. Feature, not a bug of this environment. Tape bombs are a feature, not a bug of this environment. And that's why I see that Dallas survey today. I see this turn in the S&P 500, the durable goods. This first quarter GDP is going to be such a mess, gentlemen. The Atlanta Fed actually, in their update today, produces a new addendum to their chart. We now have a gold-adjusted GDP now tracker embedded inside their chart. That's how significant the gold imports have been to the U.S. over the past few months. If we strip out the gold imports after today's durable goods figures. The economy is growing at 0.2% annualized in real terms for the first quarter. Not great.
The upshot is the same.
Not terrible. But yeah, the upshot being the same here, which is the economy, even if you try to adjust away for gold imports, you're still looking at an economy that has massively decelerated over the past few weeks. It's showing up in the soft survey figures now. I suppose the only explanation, because this is a conflict, right? Where is it in the hard data right now, Ilya? It's not really in the hard data yet. It's not in the spending figures yet.
It is sort of.
Unless you operate by the view that the reason why spending is holding up in the face of all this uncertainty in the soft data is because people understand that tariffs will provoke a rise in prices, one-off, permanently. We can quibble about that for another time, but the prices are going to go up. So people are pulling forward spending now. They're borrowing from future spending that will then fall off in the second quarter and in the third quarter. So good data now actually in this context may mean worse data later on.
Well, there is an important caveat here. So if you look at the CPI data, I think we'd all agree CPI data, hard data, not survey data. Not asking somebody's opinion. When you go into the contributions to CPI, I mean, obviously, core services is overwhelmingly the key. That's where all of the inflation is left. For example, in the most recent February figures of the 2.8% headline inflation rate, 2.49 percentage points was core services. So goods were negative, food was 35 basis points, energy was negative, flat-ish. So it's all about core services. Now, what's important here is that the contribution to, from core services has significantly declined. In fact, 2.49%, that's the lowest service sector inflation we have seen since January 2022. Now, because it's all about core services and because the U.S. economy is all services, 80 to 20 essentially, and because that's been the only thing where things have been growing, that's a reading on demand pull inflation. That tells you when you see that part of the pie is suddenly giving you much lower inflation, that the implied demand that's pulling on that inflation is weakening. And it's weakening significantly by leaps and bounds, as a matter of fact. We jumped from 2.6 percentage points in January to 2.49 in February. Month on month, that's a huge difference. And so there's a lot of weakening here under the surface that's appearing in exactly the place where you wouldn't want to see it. So it's starting to show up. The question is, at what stage does the Fed say, this is actionable, let's go? And maybe it's the jobs report next week.
But isn't that part of this market reaction today, though? Yeah. You get a bunch of data that says, actually, the Fed, you have to stay on hold for a little bit longer. Right? The durable goods was not the report.
There seems to have been an inflationary read-through to these tariffs. And I think if you look at the dollar today, you see it.
Yeah, the dollar is up across the board here today. Dylan, your beloved euro is pulling back now. So for that brief bit of time, maybe we were getting short in yours
today.
Yeah. So Dylan, I mean,
what's the theory is that the auto tariffs are going to blast the euro, that are going to weaken that make the euro less attractive, whatever that means.
I think the read through is there's a bunch of German automakers that are going to see their imports become more expensive, that's going to see interest rates in the U.S. go higher because it'll bid up the price of stuff, and that's going to see the dollar stronger. I think that's sort of the initial kind of knee-jerk that you see in markets today. And of course, Europe is taking probably the biggest hit because for them, this is a growth headwind.
And also Europe is a direct, like if you're going to do auto tariffs, I mean, I guess it's Japan and Europe are the two obvious, targets for a tax like that.
Right, which makes, again, it sort of starts to explain why this is going on. You can't compel adversaries with this kind of stuff. You can compel friends. You can compel dependencies. And so, I mean, I suppose you could try to compel China. It, too, is a dependency of the U.S. Without U.S. demand, China's export engine is basically non-existent. But the strategy seems to be we don't want less, we want more, but we're going to renegotiate the terms. Well, who do you renegotiate terms with? Your friends. So that seems to be a feature. Europe and Japan and Canada, I mean, these are all allies. But of course they are. That seems kind of the point. The issue to what you were saying before is what are the long-term consequences of this, and is the juice worth the squeeze?
We talk about that.
I guess, but your point, though, Ilya, is that at least as it relates to the euro, any dollar strength or any euro weakness, I guess it's all the same thing, should be as an opportunity.
Yes. I don't think that this changes the fact that the euro is probably going a lot higher over the coming quarters and years, because they are about to have a tremendous growth tailwind from this defense build out. And if you want to stay past overtime, as well you should, for macro money, I have a whole theory for you all with charts and diagrams and all manner of nerdy things about why you should believe Europe when they say we're going to go and buy a bunch of guns. Because we've heard this song and dance before. The Trump administration attempted to compel them with more carrot, less stick in the first administration. They're really trying to compel them with a stick this time, and it's working, kind of. And why you should believe that this is real, whereas before maybe Europe was kind of like, this is just talk, we'll just go back to business as usual after the dust settles. This is not that. And so Europe is going to have a lot of money, as we were talking about yesterday, sloshing around because of all this extra spending. And that's going to be very positive for the euro ultimately.
It's not just the U.S. manufacturers that are getting hit today. Volkswagen's OTC ADR VWAGI was down 3.1%. The BMW ADR, BMW KY, that's off by 3.1%. Hyundai has a small bounce. They still may be exempted after their $20 billion investment into U.S. plants. But you think about the exposure here, right? Volkswagen, that's 85% of the vehicles that are in the U.S. are imported, 65% for Hyundai. I've seen the number, it's perhaps in the 40% range, 37% for BMW. So there's some real exposure here for these automakers right now. I don't know what we're doing. I don't know who's being liberated here through these efforts. All these companies have said they're going to have to shut production and fire people as a result of the tariffs. So, well, except for Hyundai, they're investing $20 billion. And apparently if you want a Hyundai, you can buy one in America now. I digress. We're at the halfway mark here, guys. In terms of the sector performance today, it wasn't necessarily a good one. It's a pretty ugly heat map here on our chart. Mostly led lower by tech, and Tesla taking a big hit, being the cross-section of tech and automobiles. We see here semiconductors lead the way lower, down by 3.33%. So much for these tariffs being removed. Technology down 2.23%. Telecom off 1.6%. Consumer discretionary 1.31%. Those are all the growth names. That's bad. On the plus side, if you like defensive names, utilities are your winner today, guys, up by 1.22%, followed by, well, that's staples actually, but then utilities up by 0.66%. The defensive names are holding their ground. Dylan, you've been optimistic here about buying these dips and fading the tariff news and headlines. When do you feel like that's no longer going to be your attitude? Like, what's going to be the last?
You're saying when I would say the job. I mean, I'll be too late with this answer, but the jobs number is the most interesting thing to me right now.
Why is that?
Next Friday, because I think that the primary risk of all the uncertainty is that the uncertainty is going to generate. When you stop spending money and you stop investing money and you stop growing the economy, one of the main things that happens is a CapEx and sort of infrastructure, supply chain type things, but also you hire less people and potentially you fire people. And you do that not because, or maybe you don't fire people, but you are less inclined to hire people when you are in a cloud of uncertainty. When you have some sense of certainty, you're more inclined to add fixed cost labor to help grow your business. When you're in a cloud of uncertainty, hiring decisions get delayed or indefinitely postponed. And that is ultimately sort of the what comes back to lower sooner. And also, as has been widely discussed, and this is no secret, the Trump administration wants lower rates. The Trump administration wants a weaker dollar and lower rates, apparently. I mean, who knows what they really want? But rhetorically, that's sort of where they drift around.
You talk about these tariff headlines going back and forth. Mexican Secretary of the Economy just announced on Twitter that he's landed in Washington and he's going to be watching Trump's auto tariffs announcement from the Mexican embassy on Pennsylvania Avenue. And then later he'll be meeting with Secretary Lutnick. Considering that Mexico's right at the top of the U.S. auto parts import list, that would make a great deal of sense. How long will these auto tariffs stick around for? On again, off again, on again, off again. But it's a feature, not a bug of the environment, guys. We have come to accept that, come to learn it. Ilya, this was not a rip that you feel like it should be sold yet. I feel a little bit worse than you do. I suppose the news for the day is how come bonds didn't perform better on a day when the equity market melted down? I think just we're taking the near-term Fed rate cut odds and pushing them back a bit more, aren't we not, Ilya? There's no emergency. There's no immediate recession. First quarter is going to be so confounding to people. I'm looking forward to all the spin that GDP is much hotter than anticipated, when in reality it looks like it's tariff front running to pull the spending forward.
Well, you kind of see it already.
What do we do here with bonds?
I think you wait. So today is obviously kind of a ugly day. It's not great. But I think ultimately you've held where you needed to hold. If you, again, put a horizontal line through where the top was in early February and you look at where we're backfilling, we're still holding former resistance as support. So tempting though it is to kind of throw up your hands here and say, oh no, this thing has moved through this upward sloping trend line. This is exactly the kind of instance where I would say don't trust the sloping trend line. You can shift it around this way or that, and it'll look a little bit different. And maybe it didn't break, maybe it did. Horizontal levels don't have this issue. You've come back to retest exactly where this thing peaked out in early February. Then you had a big spill. At that time, it also took out the near-term sequence of higher highs and higher lows. In fact, that shook me out of a bond long then, and I took some profits there. This looks like a retest, and we'll see. But I'm not prepared to abandon a long position here. I don't think we've seen enough damage. Now, of course, strong convictions loosely held. Now,
as always.
now and forever. If this thing, I mean, we're not economists over here, we're traders. So if this thing is going to break down past the top that we see in February and overturns it as support, well, then now is not the time. But I don't think we have evidence of that here.
Dylan, we've previously talked about bonds and how you like Ilya's long call. So if you don't mind, if we move on to what's happening into the metal space, because copper squeezed up to a new all-time high today above $5.37.04. Wow. A pound there. It did reverse sharply. It's down into 524, so it's only 0.62% gain, and that candle is fairly ugly. But as we addressed on Futures Power Hour today, I did see a question come in over one of the morning streams recently. How come tariffs have been helping copper, but they're hurting things like wheat? And this has to do with the actual structural supply-demand imbalances that persist in each of these markets. For example, the United States itself produces about 1.1 million tons of copper per year. However, as a country, we consume about 1.9 million tons. So to make up the difference, we have to import the rest. By increasing the tariff rate, we're actually raising the cost of that copper that we need to fill in the gap. And so the copper that you see here on your screen is New York copper. And so copper on the world market, well, New York copper is now rallying to find that equilibrium, right? So if we want to import copper from abroad, these prices should now be closer in value. So copper goes up. We're in a deficit here. And the world is in a deficit right now. The International Copper Study Group tells us that accounting for China, taking China in or out of it doesn't really matter. We're in a supply deficit. Globally, we've been in a supply deficit for several months. We're not producing as much as we're consuming. So there's a supply deficit globally. The U.S. consumes more than it produces, and now we're raising the cost on a bottleneck, effectively. The commodity getting squeezed through that bottleneck is going up in price. The flip side is for wheat, because wheat prices, soft ag has been hit here fairly decently. If you're looking at corn, if you're looking at wheat, ever since the imposition of the tariffs, we go back to the middle of February. When do the soft ags peak out? They peak out right in the middle of that week of February when stocks do, because that's when the tariffs get real. Wheat, for example, the United States produces close to 800 million bushels of wheat per year. We import only about 75. It's a huge difference, 10 to 1. So when we're raising the cost of buying wheat from abroad and we're getting retaliatory tariffs put back against us for our exports, we're flooding our domestic markets with wheat. That's why tariffs are good for copper. That's why they're bad for wheat. If we're producing a lot of this stuff, we risk oversupplying our domestic market as we erect trade barriers. And if we erect trade barriers at a time when we don't have enough of this stuff internally, we're actually just pushing up the cost of acquiring it to bring it inside right now. For copper, you can't just open a mine overnight. And even if we were to wave a magic wand and say environmental regulations, traffic studies, this, that, the other thing, considerations for people's homes or well-being, throw it all away. A mine just doesn't open up overnight. So you go through a window with which there is a supply shock through the system, and we're effectively forcing it upon ourselves. So unless that changes right now, I don't know how you fade copper. I've missed a good chunk of the recent move. I was long for basically 4 to 5 and got off the train. Now I'm kicking myself. Ilya, you seem to think this candle could be a sign of a top, however, and Dylan's of the mindset that you fade tariff fear. So do you fade this move in copper? Do you get short copper up here?
I don't think we're ready to fade it, but take a look at the continuous contract here, because I think you get a good sense of what's going on just kind of thematically. Look at where we are. If ever there was a place to find a top, this looks very much like it. Now, obviously, this is the continuous contract. There's some liberties here in terms of rolling things that you have to take in order to construct a continuous contract, and thereby to essentially carry costs and kind of smooth them in a less than realistic way, because obviously you can't trade the continuous contract. You can only trade the actual month contract. So this is an indicative thing. But obviously, we've arrived at a level in copper where we've had vertigo before. And so this would be maybe that kind of a thing. It's interesting to consider that for all the jibber jabber about rare earths are not rare. Rare earths can be, with a relatively modest investment of, I've seen estimates between 20 and 30 billion in the US, which is not even a rounding error for our budget. They can be made here because they're basically a byproduct of other metal fabrication. And were we to invest just a little bit, we could have them here. It's not exactly difficult. The actual things that we need to be concerned about as far as metals and mining are things like iron ore and copper. These are the actual critical things that are, in fact, relevant for making sure we have ample supplies and the geopolitical relationships to keep them secure. So when you consider it that way, I think you make an excellent point, Chris. This is really the thing to worry about. This is the deficit that should concern us. But maybe because this is a tariff and an episodic thing, and the market has figured that what this is ultimately a negotiation, not a rupture, just a very kind of adversarial negotiation, you have a story that maybe doesn't have legs. And maybe you've seen all the legs that there is to see. Obviously, we've been talking about copper tariffs for a long time. And copper has had this massive run for a long time, detached from things like gold, which itself has had a massive run, but not like this. And so you look at maybe the market has reached a point where it looks like speculation is about to become reality, and speculative juice is going to drain out of this market for a while. That is not to say that the overall structure isn't incredibly bullish and constructive. It absolutely is. But maybe this is not the place to be a buyer. Maybe you'll get a bite at the apple back in the kind of upper fours, mid fours. 4.7, let's say.
I mean, how much of copper is tariff related, and how much of it is also speculation on China? Still, I mean, we haven't talked about China in a while, but
I got a good theory for you on this one.
Yeah, I mean, I just want to know how much.
Take a look at FXI.
All right.
Good night.
Have at it.
Good night. It's caved in on itself.
Meaning there'll be
ASHR. ASHR caving in on itself. Nobody believes this thing, and rightfully so. Because again,
China's less credible than Trump.
They haven't at all decided that they are prepared to do what they need to do. Everything they keep rolling out falls into if we let you have more money, either by giving it to you or letting you save it, won't you please go spend? And the answer from consumers was a definitive, no, we will not. Goodbye. We're sending our money abroad. And since you won't let us do it with capital controls, what we're going to do is we're going to stuff it into Hong Kong stocks. Because that we can do without asking. And that's why FXI is up and ASHR isn't going anywhere. You see it in the Stock Connect flows. Capital isn't going northbound from the world through Hong Kong into mainland. It's going the other way, from mainland to Hong Kong and out. Savings are outstripping checking accounts, essentially, demand deposits, those things you would use to consume, 3-1 at this point. So we're looking at, I think, whatever we're seeing in copper, let's put it this way, it isn't China, because not even China believes China.
Yeah. Talk about China not believing China. Maybe we take a pivot into some shouts and murmurs here, some odd things that are happening around the world. Dylan, call me a conspiracy theorist, although I don't have my tinfoil hat on. I recall having a very distinct conversation with a one Victor Jones back in January 22 after I saw this headline. And we were debating about whether or not the Russian army was getting ready to invade Ukraine, if it wasn't just a drill. And I said, if it's just a drill, why are they putting blood supplies near the front line? You don't put blood lines near the front line. And this was part of the rationale for being long oil at the time. I bring that up because we're beginning to see some signs of interesting developments occur in some places. In particular, various Army and naval watcher blogs picked up the fact that the United States has moved a few significant assets into the Indian Ocean arena. In particular, at the Diego Garcia military base, we've moved 2 nuclear-capable stealth bombers, which, again, not maybe going to raise eyebrows on its own, but it's the fact that we've also sent over 13 C-17 airports, strategic air transport aircraft, and 10 aerial refueling tankers. Why on earth would a bomber with a range of 11,000 kilometers need that much fuel unless there was a military operation potentially being staged? It's a question that I asked myself back in January 22. Why on earth are we moving critical supplies to the front line if this is just a drill? And if we're moving all these fuel...
check if there's a signal chat that might illuminate this.
Well, there's certainly radar data available, and that's where this comes from. These analysts, and this is not just something from me, you can look up Diego Garcia right now, and you're going to see a number of stories. A UK Defense Journal blog has a whole story right now about how there's a massive American bomber buildup suggesting there's a coming strike. It's much less than posturing. I do recall, perhaps to connect to the story, that the Trump administration delivered a letter to Ayatollah Khomeini. He hasn't responded to them, although I would tell them to get in line because I'm still waiting for him to respond to my direct message on Twitter. Nevertheless, they had 2 months to come to a new set of terms for a nuclear agreement to prevent Iran from developing a nuclear weapon. And that was back in February. I'm not rooting for this to happen. I'm not hoping it happens. As always, peace, prosperity, and honor. That's what I say. And this is something that would not necessarily be peaceful. But are we ignoring the fact that there could be some geopolitical risk coming down the pipeline that we have not been paying attention to here? It's an 11.1 IVR in crude. It's meandering its way higher. It's rebounding without the stock market still. Again, I don't have my tinfoil hat on here, Dylan, but are there some things that are happening around the world that make you raise an eyebrow and say, this is unique, this isn't normal, this isn't how things usually happen if we're just saber rattling?
I don't know. I mean, I'm a bad person to ask because I tend to be very skeptical. I didn't think Russia was going to invade. And so even as I always tend to err on the side of these things are not actually going to happen more than that they are going to happen, whether it's, obviously renewing a German army for the first time since 1945 or anyway, we can go down the list. So Victor Jones is a better person. Victor Jones, I feel like, is more likely to buy into could be something. Smoke, where there's smoke, there's fire. I'm more of the attitude, is it really smoke? You know what I mean? So what specifically are you seeing that you think is evidence of potential of abnormal?
These bombers have ranges of 11,000 kilometers in a single fueling session. Why on earth do you need to have 10 refuelers with them unless you're planning on keeping those things in an air for a long time for a deterrence? type of measure.
If you put a gun on the table, that doesn't mean you're going to shoot the gun. You
No.
might need the other side of the table to see the gun, though.
Well, yeah, this isn't a Chekhov's gun situation like a theater play. This is like you're going to have all these assets staged there because you want to keep these bombers up in the air for an indefinite period of time, and that means you're going to need to be making multiple refueling runs, and you can't just risk having one or two tankers up there. You're going to have multiple tankers making multiple runs, basically around the clock, won't you? Just putting together the pieces. If it's just a stop off,
and if
you refuel the planes
in the Indian Ocean.
Well, why else do we use the Diego Garcia base? Like that's staging for a Middle East theater, for Iraq, for Afghanistan, for
and maybe
Iran.
For a peace deal that is needed in the Russia-Ukraine theater, whereby you need to compel Russia. And
we're
say,
on Russia's side now. You mean compel Ukraine?
I mean,
you have to compel
at
Ukraine
this point,
to do
it looks like. I think at this point there is no side, and that's really what's the most interesting about this. Is I don't think that there is a side. Whereas I think the change is whereas before there was a side and it was Ukraine, now there's not a side. And that seems to come through. Now it's just a transaction. It's just deal making. And if the goal is we want to end the war and Zelensky won't come along, then you need to browbeat him. And there's the added benefit that the Europeans get spooked and finally build out NATO forces like you've been asking them. And if Russia doesn't accept, well, now you have to browbeat them. And where do you hit them? You hit them where it hurts. They're ways around your energy sanctions. Don't let the shadow fleet come to India. All of a sudden, everybody starts becoming very interested in an unclenching.
Dylan, you mentioned that Germany's raising an army for the first time since 1945. Former ECB President Mario Draghi, Italian Prime Minister Draghi, he said that Germany's decision to ramp up defense spending is a game changer, but he said he sees risks in Germany rearming itself while others won't. That's good.
Thanks, Mario.
That's really good.
One of my favorite central bankers of all time, by the way, because of one single presser response. He was asked, I want to say in 2012, shortly before he made the statement that shook the world, that we will do whatever it takes to safeguard the euro. A reporter asked him about something or other with Greek debt. And he goes, listen, every month the market has an angst. And this month it's this angst. And next month it'll be something else. I just thought that from the head of the ECB at a post-meeting press conference was possibly the greatest central banker response to a question ever. Other than maybe Jay Powell's definition of the neutral rate as something that we will know by its works.
Oh, my favorite Jay Powellism is when he yelled at those protesters to get the hell out of his conference.
That's right.
Shut the door.
Shut the door.
In more colorful language. All right, Dylan, we have one more day left of overtime this week. We have 2 more days left in the trading week here. We're still waiting on the tariff to be signed. I was hoping that we'd get some auto tariff news here during this episode or during this hour so we could talk about it and see what's actually in it. Because quite frankly, if he signs a bunch of auto tariffs and it's like, this is actually not that bad, the market's going to erase all this tomorrow. But I digress. What are your most important things through the end of this week?
The only thing, as I said this entire week, is the Trump administration and their tariffs. That is the thing. And I don't think it's any different now than it was, 2 days ago. And I think that today's activity actually serves as evidence of that. That it serves as evidence of exactly that factor, which as soon as there's a new tariff talk, the thing flips over. And Amazon, not just the car companies, everything goes. And I think that between now, I guess the earliest point between now and the jobs number, you're just not going to get anything happening until until you have that information.
Curious that the auto tariffs haven't been announced yet. Maybe they're waiting until 5 p.m. when futures markets close.
They're never happening.
Yeah. Or maybe they're never happening, right?
Or maybe they're never happening.
I think they might be happening. But, telling you, that's what I'm thinking in my head right now. Would I make a market for someone right now? Like if you said, okay, Chris, let's put $100 on it. I don't know that I would.
Exactly.
Yeah, I don't know.
Exactly.
And maybe that's the point.
Oh, God.
That is the point.
I'm getting too old for this,
Which
man.
is why you got that Dallas Fed thing, whatever that comment was from the Dallas Fed guy saying, I've never had more uncertainty in my life and blah, 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 blah. That really sums up everything.
All right. Well, you know what, guys? We are running out of time here on Overtime today, and we're waiting on these auto tariffs. So we'll just call it there. It was a bad day for these markets. NASDAQ down near 2%, NVIDIA off by 5.76, gold up a little bit, copper surges and then comes back in. It was an interesting session. But you know what? We have more Tasty Live coming up after this. Ilya Spivak is on with Macro Money next. Today, I am on The Price of Truth. Mixed that up yesterday. So be sure to stick around. For Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. We'll catch everyone on the other side of a quick break. See you soon.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number 1 for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. tastytrade. Make your move.
Mike, what does it mean to be assigned?
When you are assigned, you are ultimately short an option that's in the money, and the counterparty has the ability to exercise that option. So if you are assigned, it means your option, against your will, ultimately, has turned into 100 shares of long or short stock.
What does a green scratch mean?
Ooh, a green scratch refers to stubbornness getting the best of you. And when I say you, I mean me. Green scratch refers to rolling a position, defending a position, and instead of just closing it for less than loss that you're seeing, or maybe a $100 loss, $50 loss, a green scratch is when you close it for maybe a 5-cent winner, 10-cent winner, 15-cent winner. Just the ability to see that green number on your screen and get out in a profitable way as opposed to a loss.
It feels good to get smart. Get even smarter with the ultimate how-to guide. Learn 31 different option strategies, covered calls, iron condors, jade lizards. Become a trading mastermind. Get the guide at tastylive.com/guide.
I got Joe in Houston. What's up?
Just want to call in and say I really appreciate everything. I started trading and learning from you guys about 6 years ago. You know, it was you guys' work and the platform that got someone like me that didn't really know anything about the market capable of really outperforming the market now for, 5 out of the last 6 years. And so I really appreciate you guys. And I can't think of another company where I can pick up the phone and call the CEO, the trade desk, and reach somebody as quickly as I can there. So just really appreciate everything and what you're doing for guys like me out here. What you're doing is really spectacular. So really appreciate it.
Thank you, my friend.
I really appreciate it.
You made my weekend, man.
If you missed the live show, here's our cherry on top weekly recap.
I got my Ted Lasso.
You actually have pants on.
Yeah, of course. I'm in school.
Huh, got it.
You're
It's cool.
flexible.
It's cool.
Oh, nice. You are pretty flexible. Let's see you get that leg up again.
Oh yeah, he's really. Right now, my other leg is cramping.
I believe that to be true.
We just ripped higher up to 50 points, and I just thought we would stay there, but
The thing the market does best is it keeps you very humble.
You get paid a lot for being right, and you lose a lot for being wrong.
So give me, I don't know, a couple hours, and I will give you everything that you need to start trading options. See you inside.
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty Trade. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah.
It's the day that when you write dates in the American system of month, day, year, which is a little bit funny, looks like 3.14, which is one of our better approximations. And actually this year is even better because it's 3.1415. I've never before, but this year there's a couple other math people who just got a pizza oven, and so they're bringing everyone over. We're gonna make a bunch of pizzas. It's one of the few very important transcendental numbers, right? I mean, 0, 1. There's a lot of good contenders for most important number. Anytime you have anything that's circular, you're gonna wind up with pies. Anytime you have a pie, you should sort of expect there to be something circular. I can do one more than the date on Saturday. I can do 3.14159. Irrational numbers are fractions, and pi just is not a fraction. 22/7 is pretty close, but that's not what it is. It's the ratio of a circle to its area, right? And so that's not an integer ratio. It just isn't. Oh. Pumpkin. Circles are great.
If you missed the live show, here's our cherry on top weekly recap.
What is going on over there, girl?
His hat was a late entry today. He came in. Oh, it's all jaunty now. You gotta move more towards your left.
I hate when that happens.
Your other left.
Like when you can't get your
you
can't get your bangs right. Oh, I hate that.
I know. You know.
I hate that.
What's going on with you? I'm watching you walk. What did you do? Did the corned beef king of Chicago get taken down by his own corned beef?
Looks like it.
Is that what happened?
Looks like.
You gave yourself the gout, so you use your phone to take pictures. Like if
the print on like a bottle or package is too small, if you take a picture of it, you can make it bigger.
Yeah, I do that all the time.
That. My eyesight is perfect.
We literally tweeted a photo of you out this morning.
Put that photo up.
Be so for real right now. Oh my God. You can hear them laughing. You can hear them laughing.
Studio, but that's Tom right now. That's my view of Tom. Beautiful. He came in wearing that today.
Wait, what does the back say? Does it have your name on it?
No, I would never wear a shirt. Now, I'm glad you brought that up because only the biggest loser in the world would wear a jersey with their name.
Hey!
JJ.
Put him up.
Only the biggest loser.
There they go. Scott, what's up, my man? How's Japan?
Scott, you better have not worn the jersey with your name on the back. Nobody wears a jersey with their name on it.
Look how good that looks.
That is so lame. I'm sorry. You can't do that. I'm so embarrassed that JJ is wearing that jersey.
What does it matter to you what someone else wears?
There's a code.
What is the code?
It's all right.
There's a code. In Chicago, if he wears a jersey with his name on it, somebody's gonna throw a beer on him.
Would you like to say hi to Mr. Tom Ricketts?
We're having an argument on air right now, and you got to put it to bed for us. JJ's wearing a jersey with his name on the back, and we're arguing whether or not, according to the guy code, you can wear a jersey to a game with your name on the back if you're not a player.
Mr. Out the archives at tastylive.com.
Stock markets take a leg lower because we're apparently going to get a run of auto tariffs coming from the White House, but we don't have the announcement yet. And ultimately, the markets don't run too far away. So while we wait for fresh fodder, we'll take an opportunity to look at a bigger, maybe even a more impactful story here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live. And we are going to turn our focus to Europe because this has been a major part of what we've seen come out of the new Trump administration in the U.S. and the realignment of global relationships that it has engineered or is engineering. Of course, one of the biggest stories here has been the idea that Europe has become skeptical about the reliability of the U.S. military umbrella and wants to build out a massive rearmament effort so that it can take care of its own defenses without relying on the American backstop for the first time, really, since World War II. That has moved markets because, of course, such a thing would imply a tremendous amount of spending. And the real question is, well, we've heard this song and dance from Europe before. In fact, in the first Trump administration, there was an attempt to get NATO, that is to say mainly Europe, to build more guns for themselves and to shoulder more of the load for NATO and a more representative share to their actual membership. And so is this, in fact, different? Because the last time that this was attempted, Europe ultimately said all the right things and didn't do very much. Is this time different, and is the market reaction then going to actually be sticky? Can we trade on it? That's what we are going to focus on here today. So first, let's take a look at what the markets have done so far, and then we'll take a deep dive into why the markets will or won't believe, then come down to a trade idea on that basis. So, First and foremost, we can see the U.S. dollar has been down since the beginning of the year, and the euro has led the way. Now, of course, we can see the dollar has pulled off a little bit of a recovery here in the wake of last week's Fed policy announcement, where the Fed basically said we don't need to rush to cut interest rates. But we can see from the beginning of the year, this is the start of 2025 right here, the euro has clearly been an outperformer, starting basically from late February going into March. So the yen here was outperforming, and then the euro from about late February into March rapidly surged ahead, at one point up as much as 7% year to date against the dollar. And of course, now we've seen this pullback, the euro still right on the leaderboard there with the yen, but a little bit of dollar strength here pulling the entire complex down. Nevertheless, we clearly see that something happened right here to dramatically catalyze the euro, and to a lesser degree the pound, but certainly the euro, to this dramatic outperformance. Of course, the first step in figuring out what all is going on here is to see what is the driver of the euro-US dollar exchange rate. And we can see that here in clear representation. The purple line here, the spread between German and US two-year bond yields, that is to say the front end of the yield curve in the US and in benchmark Germany, which is a stand-in for the Eurozone writ large, typically. It's the largest economy. And so we see here this very close relationship between where the euro goes relative to the dollar and this spread, which of course makes all the sense in the world. This is classic stuff for currency markets. The currency you want to own is the one that confers a higher yield. And we can see here that as the yield differential between Germany and the US moves, so too does the exchange rate, as the yield advantage or disadvantage of the given currency moves around relative to the other. So here, for example, we can see from January of 2021, we start to have, from about mid-year, a conversation at the Fed saying, okay, it's time to hike rates. The hikes, of course, don't start until well into the first quarter. In fact, toward the end of the first quarter of 2022. But of course, markets are forward-looking. They speculate. So once the Fed around June of 21 starts talking about, okay, maybe this inflation isn't, quote unquote, a transitory thing, and maybe what we need is to really go on a hiking cycle, you see yields shift against Germany. So as this yield narrows, that's U.S. yields going higher and German yields losing step, relatively speaking. You can, of course, see that this is reflective of the U.S. having a yield advantage compared to Germany. And so here you go from about a negative 1% disadvantage for Germany down ultimately as you get into 2022 of a disadvantage in excess of 2.5%. And the euro follows. Subsequently, you see things correct. Most recently, of course, from September of last year to the beginning of this year, the markets were thinking maybe the Fed is sounding too dovish and they're not going to do all the hikes or all the cuts, rather, that they are saying. So you get a shift, again, in the dollar's favor in the yield spread, and the dollar strengthens. And then, of course, since the beginning of this year, you go the other way again. And this is the most recent surge in the euro. And you can see that, right according to form, it matches with an upshift in relative yields, where Germany looks a bit better on the relative yield spectrum compared with the US than it did before. And that's how you get the move in the spread and in the currency as well. So what's going on here? Well, as with the exchange rate, so to the yield spread, there's a pair in this dance. On the U.S. side of things, we can see from September through to the beginning of this year, inflation expectations implied in the bond market, that's these break-even rates up here, the 5 and 10-year, they're rising. The yield curve is steepening. The 2-year, the 10-year rates, they're going up. Bonds, of course, in parallel are falling. And the dollar here, the dollar index, it's up. That is this move right here. And what we see since then is inflation expectations start to roll the other way. The dollar starts to roll the other way. Yields start to roll the other way. We start to see the change in this yield spread. We start to see the euro perk up. So from the U.S. side of things, you have lower U.S. interest rates, of course, shifting the yield gap in the euro's favor in relative terms. And we know at this point how this is happening. The leading PMI data, essentially a measure of business confidence over the past 3 months, has screamed that the economy is threatened by uncertainty around tariffs and fiscal policy in general, and companies are pulling back on spending, and that's hit economic activity growth, including in the service sector, which of course isn't immediately hit by the tariffs, but is impacted by them tangentially and in sentiment terms. And that's exactly what we've been seeing. So the market has taken to expecting that this will mean a more dovish Fed. And last week, the Fed didn't take the leap, but certainly commiserated with markets and said if only we were to see this kind of weakness go from survey data like business and consumer confidence to hard data like jobs and inflation, well, then we'd have to act. As if to say, yes, markets, you're right that we've become a bit more dovish in our thinking, even if we haven't in our actions, and sort of endorsed this move. At the same time, on the German side of things, yields have surged. This is, of course, looking a whole lot like what you see both in the yield spread and in the euro. And you can see it happens in the transition from February to March. So if you were wondering how the euro was lagging here and then surged to outperformance, this is the move you're looking at. And this is the bond move behind it. So not only is the U.S. side of the yield spread moving such that you get more euro advantage, but you likewise see the same thing from the European side. That is to say, their yields are moving in a way that even further shifts the yield spread in the euro's favor relative to the dollar. Okay, so apparently the markets have heard the idea that in Europe you now have increasingly the president of the European sort of regional legislature, Ursula von der Leyen, saying that what we need is a big build out of defense spending. You're seeing Germany, forever the tightest purse strings in Europe, basically since they had the hyperinflation leading into World War II in the Weimar years. Germany has been incredibly suspicious of debt and of expansionary policy. You nevertheless have a situation where they've said that with the need for a military buildup, you now have a exemption for defense spending from the constitutional debt break that would cap that kind of spending in Germany. And of course, if you were to now have a huge amount of money pouring into defense contractors, that suggests a huge boost to economic growth. The numbers that we're talking about are astronomical. from the lips of incoming German Chancellor Friedrich Merz and other leaders. Of course, France's Emmanuel Macron, the president there, he's argued for a more assertive European posture for a long time. He's talking about a European nuclear deterrence independent of the U.S., powered mainly by France and the U.K., both nuclear powers. So there's clearly a level of spending that the markets are anticipating will come, and they think it's a lot, and they think it'll be a tailwind to growth, which of course then is a tailwind to inflation. It means fewer rate cuts from the ECB, so it means higher yields and higher euro. So far, so good, but do we trust it? Should the markets trust it? Or is this again a familiar song and dance? Well, certainly looking at German inflation expectations, they seem to have taken notice, and in the near term. So if we look at longer term inflation expectations, they jump on this news, but then they sort of settle to where they were before. And this is 20-year, 5-year, in this case, the 10-year with remaining 8 on it for the current bond. But near-term inflation expectations, they're still surging. They're still at some of the highest levels that we'd seen in 6 months. After this rebound, there was a pullback here, but now we're right back up here. And this seems to suggest that the inflation that the markets are anticipating is coming near term. That the spending is going to be front loaded, that the impact is not in some distant future. Moreover, ECB policy expectations have taken notice. Not only have we seen the stock of rate cuts for this year diminish a bit, but now, for the first time in really going back to the beginning of last year, the markets are actually anticipating about a 50-50 shot that the ECB will have to raise rates next year. 14 out of 25 basis points of a rate hike are now on the menu here. And that amounts to about a 56% chance that the ECB hikes rates. That obviously speaks to a significant inflationary impetus from stronger growth around this build-out. So again, the question becomes, well, the markets believe it now, but will they still believe it later? Or is this, again, another one of these rhetorical things that ultimately fades? And this is where a bit of theory helps. The great economist Robert Mundell came up with something called the optimum currency area theory that seeks to explain why a country would want to join a currency union. And this really tells you and illustrates very nicely how it is that the EU and indeed the Eurozone came to be, and explains all of the economic troubles, hiccups, and various crises along the way, and how what they've been in practice isn't so much an existential threat, though it feels like it at the time, but rather a forcing function for the project to advance. So consider this. If you're a country, some would-be country, that wants to join a currency block with some group of countries or one other country, but you want to consider whether you should have a joint currency and enter into a currency union, as the Eurozone is. You have a structure of costs and a structure of benefits. Over here, you have the degree of prior integration. So how close is your economy already with the block or the block of economies or the economy that you're seeking to join. And over here is just costs and benefits in some theoretical units. And the logic goes like this. If you join a currency union, you lose independence of monetary policy. In other words, you have a single currency, you have a single central bank. If you need interest rates to be lower because you're in economically dire straits, but the bloc needs them higher because they're doing well, then that's not advantageous for you. But if there's already a lot of economic integration, then chances are that you go through booms and busts at about the same time. And so you don't care about giving up some monetary policy independence for the benefits. And the benefits are, of course, the more trade you do, the more integrated you are, the more you extract from reducing friction, like borders, tariffs, quotas, all manner of rules getting a common denominator between you and the currency bloc. All of that makes doing business cheaper, easier, smoother. And of course, that is a tremendous economic benefit. So the more that the would-be joiner of a currency union is already integrated with the union it wants to form or join, the more it cares about the benefits. So as integration goes from 0 and up, the more the benefits matter and the less the costs matter. And there's a magical, obviously theoretical, equilibrium point here, beyond which the benefits outweigh the costs, and it makes sense to join the bloc. Let's follow this logic to look at the European Union, and if you look at it on purely economic grounds, even Robert Mundell himself would argue that the Eurozone is not an optimum currency area. That is to say, it is not economically sound. The level of integration is insufficient. Even things like the Maastricht Treaty, the Stability and Growth Pact, that mandates greater degree of symmetry and integration by saying members have to have certain budget thresholds. They can't run higher. They have to have certain common economic criteria, convergence criteria, they're called, so that there is symmetry in these business cycles. We, of course, find out in practice those things were not there, but integration happened all the same. So economically, it didn't make sense, and we have a litany of crises along the way to demonstrate that this integration ex ante was not sufficient. Certainly the Eurozone debt crisis of the 2010s, 11s, and so forth, that makes the point loud and clear. But nevertheless, we have this thing created. How? Well, consider what mutual defense does to this calculus. And consider that the first European communities were European coal and steel, military industry, European atomic energy, military industry. That's in addition to the trading bloc or customs union. And so you immediately see that the goal starts being France, basically, saying we want to be integrated in German military industries such that German tanks don't roll into Paris again. And when you consider it in the context of this model, you would say, well, is it an economic benefit if there isn't war? If you reduce the chance of war? Of course, the answer is yes. If infrastructure isn't being destroyed, consumers aren't being conscripted, then the economy isn't being disrupted. So the avoidance of war is an economic good thing. How do you reflect that in this chart? Well, the area where benefits outweigh the costs should get bigger if the thing you're doing is good for the economy. What does that mean? Well, it would mean the benefits line shifts by a force other than the costs and benefits themselves and the degree of integration. Some outside force shifts the entire line such that this area grows by this right here. What does that tell us? It tells us that the acceptable level of integration goes down. And now the participants will accept less economic perfection in the structure because the military benefits outweigh. And this is the story of the southern expansion, where Greece, Portugal, and Spain are admitted, even though they don't have the economics for it. This is, of course, the initial conception of the entire thing, and France wanting veto power over German military might. On and on and on it goes. And every time that this thing hits a crisis, much as now, this logic is the forcing function for deeper integration and for the killing of sacred cows and for the breaking of things that were thought unbreakable and for the creation of something which maybe doesn't make initial sense. So the upshot seems to be that Europe should be believed. This fiscal tailwind really is coming because this is exactly the kind of forcing function that usually moves Europe to finally get to doing stuff. And so this pullback that we've seen in the euro here after this surge, resting now right around the 108 area, looks much more like a buying opportunity than it does the fizzling out of a move that isn't credible. And although we don't necessarily have confirmation to get long at the moment, the upshot seems to be that wherever this settles, here or perhaps a bit lower as we continue to probe down, the path of least resistance, perhaps structurally now for the euro, is higher. And this weakness is a chance to participate with a bit of a bargain price relative to what we saw even last week. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money's back tomorrow.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Looking for a better broker and a bonus? Sweet. Get up to $4,000 when you open and fund a Tasty Trade account. Plus, smart tech and a broker who's got your back at Tasty Trade. Make your move, genius. Tasty Trade.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
much does it cost you guys to do simultaneous hair flips?
Years of practice.
I got the bag. Everybody wanna be like me. Yeah. Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, the one, the only, Shelly Van. Shelly, what's up?
Hello, hello.
How you doing?
Good, thanks. How about you?
Can't complain. We're here. We're working for the weekend, so I would love to know what you're getting into this weekend. Chat as well. Get your ass over to YouTube if you're not watching it over there. Type some crazy stuff into the chat. Let us know you're alive. Let's get it going here. Shelly, what are you doing this weekend?
Not anything planned, really.
It's going to be like 75 on Friday.
I'm going to be outside.
Partying, hopefully. Okay.
Yeah. What are you doing this weekend?
I'm heading out to South Carolina for a wedding, so I'm off for a couple days. But fear not, we will still send the email Saturday morning.
Yes, we will.
Yeah. Got to pump that a little bit. If you're not a subscriber to, how do we bill it? Or we used to bill it as the best crypto email you've never read. Mm-hmm. It's been growing. The list has. So some people are reading it. But if you're not an avid reader of the Tasty Crypto newsletter, next to Orange on Saturdays in our midweek market update, sign up over at tastycrypto.com. That's a little commercial for the beginning of the show.
Well done. Well done. We got some friends in chat.
You have a question for the chat?
I do.
All right. What do you want to know?
What makes you belly laugh? Like unreasonably laugh?
Getting tickled. No, that was weird.
It'd be creepy.
Yeah, just the first thing that popped into my mind. Sorry. What makes me belly laugh? I don't know, like a good stand-up
Okay.
comedian.
Okay.
You know, post like a little gummy action maybe.
All right.
Need a little amplifier sort of thing. I don't know. What about you?
People falling. Shameless.
Like an old woman tripping off the curb sort of thing? Like that's hilarious?
Nobody getting hurt is funny, but like, you know, people who eat shit just like because they're clumsy.
Okay.
Or like getting, you know, a dog.
Like slipping on the banana peel.
Yep. And cats. Funny, like cats getting startled.
Okay.
Golden.
All right.
Mm-hmm. But chat, what makes you laugh? My mom, Laura, people falling down. Yep. Maybe that's where I get it. What's up, Grumpy Mike? Crazy House. It's a good name. Jose's here.
Ben Butler.
Tickled is a horrifying documentary about the sport of competitive male tickling. 5 stars.
I know what Demi's talking about. I haven't seen it, but I have seen like the thumbnail. I don't know if it's on YouTube or Prime or whatever. I do know what you're talking about, though. I think it has some weird twists and turns.
Yeah, we'll save that for another show.
Yeah, that's your homework. Watch the Tickled documentary we'll discuss on Monday. Let's get the show started. Shelly, you're in the driver's seat. What do you want to talk about today? We've got new tokens. We've got liquidity pools to cover from last week. We've got markets chopping around here. Happy to go anywhere. What do you want to do?
Let's start with the new tokens.
Okay. Slides, please. Loading. Boom. We've been adding new tokens. Tasty Trade, I should say, has been adding, not necessarily me or we, but this business.
You get a lot of the credit, though.
I help to push some things forward at times. But Tasty Trade's been adding new tokens, going to continue to add more tokens. And we've talked about some of the recent additions. I want to cover really quickly two that I think are interesting. Personally, I've had investments in previously, so full disclosure, I'm not really here to pump my bags. They're not big enough to pump, I suppose. But these are two that have been on my radar for some time, SWE and Aptos. We've added a bunch where it's hard to know the differences between some of them at times, right? On one end of the spectrum, we've got memes, we've got Shiba Inu, Doge, Pepe, and then on the other side of it, we've got, monolithic L1s. So there's a lot in between as well, but I want to talk about SWE and Aptos. Are you an investor, trader, participant in either of these tokens?
You know I am.
Absolutely.
I traded SWE a little bit a couple months ago, made a bit, and then was pissed that I sold too soon. So I bought back in, And I just bought Aptos recently because relisted them. I was like, ooh, I'm not familiar with that one. So I aped in, as I do.
Awesome. Hey, it's a good way to have some skin in the game and to maybe force yourself to learn a little bit more about them. If you've got it on your watch list, you've got it in your portfolio. Throughout the past couple of cycles, there's always a narrative or multiple narratives that emerge. And at one point, Solana was kind of deemed an Ethereum killer. Not necessarily true, but similar L1s. That was a theme. It was a narrative, at least. And you're starting to see something similar emerge again, where you have these other high-performance blockchains, SWE, Aptos, which we'll talk about, emerging as these kind of Solana killers. I don't think that's necessarily true, and we're going to talk about this in the email over the weekend. But I want to hit on these and to kind of present them from that investment case. If you think that there are, real-world use cases, clearly there are for Solana. There's utility there. There's users there. Well, you're seeing the emergence again of these other high-performing chains, or these new high-performing chains, I should say. So let's talk about those really quickly. Then we'll jump into the liquidity pool that we put together, talk a little bit about the markets. But SWE and Aptos, new tokens now available on the Tasty Trade platform. They're high-performance L1s. They've both emerged from kind of the same place. That was Meta's Diem, also known as Libra, the stablecoin project that got shut down. They both use the Move programming language, so they're similar. That's the point here. They both also employ parallel transaction processing. We're not going to get too deep into the weeds, but that's the key takeaway. It's how they process transactions is what makes them unique.
So, quick visual. People standing in a line where the first one gets to go, second one gets to go.
Yes.
Versus
your bus stop graphic, not so much graphic, but the
right. So
little app that we
you
showed.
have to wait in line for your transaction to process. These, it's like multiple checkout lanes.
Yes.
Where they're being funneled through simultaneously.
That's the best way, absolutely, I think the best way to think about parallel transaction processing. All happening at the same time, hence the higher performance versus sequential transaction processing. Not that it really matters for this show, but SWE uses something called object-based architecture, while Aptos uses what's called block STM. So just to touch on parallel execution, as you've already mentioned, this is the process of transactions being verified, being processed all together in parallel versus the way that most blockchains do it, which is one by one. Solana is very good at this with proof of history. It can order things very, very quickly and efficiently, but it is in a sequence.
Right.
Through parallel execution, instead of waiting in line, like Shelly mentioned, many transactions are processed at the same time, just like having multiple checkout lanes at the grocery store. So that is the big difference here. That's what makes these special, in my opinion. We can just break these down really quickly. I think the examples help. So when we look at SWE's object-based architecture, it's similar to treating every smart contract, every asset on the blockchain like its own file. Instantly, it can process unrelated transactions all happening at the same time. The way to think about this would be if the SWE blockchain network, which is still relatively nascent, is used for blockchain gaming. You might want to buy a skin, buy a weapon, whatever it is. You don't have to just get in line and wait for someone else to buy something and that transaction to be processed. Everyone can do this at the same time. So that's one way that you might think about it. If we look at block STM, very similar, same concept. What makes this special is that it's smart. So when you look at DeFi, you could have a DeFi platform. You have all these different smart contract interactions that are all happening in parallel. But there's certainly a chance that you could have two parties, two actors that are trying to complete the same transaction at the same time. This is smart enough then to let everything else kind of happen and then solve that problem on its own. So if you look at these, they're largely they're very similar, put it that way. But I can kind of look at this as like, okay, SWE, better use case, or one space where, it might be optimized is blockchain games. Maybe you look at DeFi as something that Aptos is better suited for. Not necessarily, still very, very early. But again, the big takeaway here is just how they process transactions versus a lot of the layer ones that we're familiar with today. So that said, just really quickly, a comparison between SWE, Aptos, Bitcoin, Ethereum, and Solana. You can just see how much smaller they are in market cap terms versus Bitcoin. Of course, you can see that nothing has done very well this year. From a performance perspective, Bitcoin's down, but not nearly as much as some of these other tokens are down. And then when you look at relative performance versus Ethereum or versus Solana, SWE and Aptos have done a little bit better versus ETH. Solana still leads if we're trying to say that these are ETH killers. Well, not so much in performance terms. So
I like this laid-back trader says people don't really care. It just needs to be fast and cheap.
Absolutely. Yeah. And again, it's still very, very early. I don't think it's a world in which there's a single chain or winner takes all. You probably have a multi-chain world. Maybe they work together, maybe they don't. But you probably see the emergence of certain use cases that rely on certain blockchain networks and their relative technology versus others. ETH is good for certain things. Bitcoin is good for certain things. Solana is better for this. SWE, Aptos might be where these things happen. Still very, very early, but wanted to cover that here today as these are new tokens at Tasty Trade. We got that over with. Where do you want to go next? Unless anybody has any questions that we can possibly answer.
Women in the pools.
Okay.
And Jose laughs when people crash on a glass door. Also hilarious.
Okay.
Like the screen door, you just don't see it. Have you done that?
I've never done that. No.
Oh, I have.
I've seen it done.
It's magical.
Yeah. The glass didn't break, did it? No. Okay, that's good.
It's just smashed face,
I've seen someone go through the screen. I mean, the screen completely comes off the tracks and, smashes on the ground. But I've never seen the glass door.
Yeah. Not like break.
Break, yeah.
But when you just
yeah.
Or push on the pull and, yeah.
Let's talk liquidity pools. If we could throw up our browser here, we'll jump over to Uniswap. If you recall, last week on the show, Shelly and I put together a small liquidity pool to show how to do that in the Tasty Crypto app. Connect to Uniswap. You need, in this case, ETH and USDC. You put them into the pool, and then, you basically just track the process or the progress. So that said, Shelly, we set up a pool with about $300 of ETH and USDC. And now we're going to take a look at how we're doing. Which, these are not giant numbers. I get it. $3 is not much. But this is a 1% return pretty passively, really, on a 1 week basis. So if you extrapolate that across a year, you have an annualized return that's quite a bit higher than what you might get in a checking account for sure. It's going to be a lot more volatile. You can see the current APR, and this is going to be a function of the price of Ethereum as well, as that's going to be quite volatile. You're going to see these things move around. Current APR, as of this moment in time, since it's been calculated, is 26.3%. And you can see our range here is 1850, 2244. But we can jump into this. We can talk more about it. This is the pool that we set up, though. You can see it's still a little 50-50 or close to 50-50. So we started with 50% USDC, 50% ETH. And I have a little bit more ETH in here now, which means that the price of ETH has gone down a little from where we started.
Can you toggle and show the price range in USDC?
Yes.
So it makes more sense. Yeah. So that's your range. How are you keeping track of your pools? Like, just quick, what did I go in at? How much did I pay for the ETH when I put it in? Like, your profits and losses. Like, how are you keeping track of that?
Yeah, the easiest way to eye that up is just simply to look at how much of each asset you have in the pool, or you can see where it is here relative to the range that you're in. So typically you're going to come into this, at least when we did this, and we would put it on where the top of the range is about equidistant away from the bottom of the range. Or if I say that differently, you're the same distance away from the current price when you put the pool on, when you set your top and you set your bottom of the range.
Came in at the middle.
Yes.
Yeah.
And then we can see how that's moved just given how much more or less of one token we have in the pool. So if we come in at 50-50 and we see that we have more ETH than dollars, or we have 57% more, to me, that signals that the price of ETH has gone down because my pool has been buying ETH. People have come to the exchange, they're selling ETH, they're buying dollars. We're facilitating that process. We're making a market, or we're participating in the market-making process. It's automated through the AMM. But I know just by looking at that the price is a little bit lower. I'm not too concerned with how much it's moving within that range. More so, I know when I'm out of range, if this price instead of 2006, is below 1850, I'm out of range. I'm 100% ETH. I know I've lost money.
Right.
Because I bought ETH as it was going down and it went lower. And then if it's at 1850 in terms of the bottom of the range, but the price of ETH is at 1800, 1700, I'm going to keep losing money. The risk here, and this is very similar to selling a put in options trading, the risk here is that I've seen my pool go to 100% ETH from where I started, and then ETH goes to zero. So that's ultimately the risk. And then on the other side of that, if I see that the pool is out of range, I'm going to see that, one, just given there's an indicator here and the market price will be above 22.44, I'll be 100% USDC. No problem there because I made money on the appreciation of the ETH as I was selling out of it, as the pool, or the price, I should say, moved closer and closer to the top end of my range. But there is an opportunity cost associated with that. So that's also a risk. That's very similar to selling a call option and taking assignment of the stock, or I should say selling a call against stock that you own is probably more applicable because you would be getting out of the position. So I no longer have any ETH. I can't participate in further upside. I now just have dollars. And so if the price of ETH goes from 22.44, where I go out of range, and it goes to 3,000, well, I missed out versus if I just owned ETH at 2,000 and I wrote it up to 3,000.
So when do you pull out all liquidity and either start a new pool, add to an existing pool? Like, how many pools do you have going, and what is your strategy there?
Right now, I probably personally have 7 or 8 pools that are going. A lot of them are out of range because they were started at higher prices. So I guess it depends on what's happening in the market. It also depends on your directional bias, or are you bullish or are you bearish? So in the case that we have a market that's trading higher and you think that it's going to continue to trade higher, what I'll often do as that pool goes out of range to the upside is that I will sell some of the ETH, or in this case, I'll take some of the fees that I've collected and sell that back into USDC. And so I will take some of it. So I'll kind of almost like trade it a little bit. So I want to capture some of the profit. And now I know that if I started with, we'll just arbitrarily say I started with a $10,000 pool, 50% ETH, 50% USDC. The price has gone up. I'm selling out of ETH at higher prices. I will put on a new pool as long as I'm still bullish, check the charts sort of thing. But I'm not going to come in with the full amount considering that price appreciation. Maybe I've made $500, $1,000 on that $10,000 initial trade. Maybe ETH goes up 10% or whatever. I'll come in and set up a new pool at the new prices, but only use $10,000 worth of capital. Keep the other on the sideline and use that, in some ways as a downside buffer, but that was the trade. So you made money on the ETH appreciating, but when you go to put this back on, don't increase your risk. And now I have a pool that starts with $11,000 or $12,000. I'm still coming back in with a $10,000 pool at higher prices, but I've made some money that I'm keeping on the side. I'm also taking the fees out and keeping them on the side as well, keeping them in the wallet. On the downside, I don't really do much. Hope and pray, if that's a strategy.
It's currently my situation.
Right? So you get these big swings. We're used to it. But ETH goes down 30%. You're out of range.
Right.
If you want to rebalance because you think that there's no chance it's going back up and you're just going to chop sideways, you want to generate fees, you can do that. But you've been buying ETH on the way down. Now you're selling the bottom to swap that back into 50% dollars, 50% ETH so you can put the pool on again. I typically don't do that unless it's something where we're very close to the bottom of the range and I want to continue to participate in this market making process. Maybe I come in with a wider range. There's a lot of different ways that you can configure it, but I typically won't sell out at the bottom.
Yeah.
Now I'm 100% ETH. I'm at a level where if I think it's going to bounce, I just want to be long ETH. If it bounces, we get back into the range of that pool and it starts to make markets again or facilitate the process, provide liquidity.
So on the way down, though, if you are 100% USDC, couldn't it be pull it all out, buy more ETH, and throw it into the next tier?
You would, on the way down, you would never gain more USDC because the price would be dropping.
I said that, I said that wrong. Wouldn't you take that ETH out and then put it into a pool that's the higher tier up? Meaning like you've set another range that's now in range for a pool.
Oh, if I had... Yeah, you could add...
Basically like shuffling your pool.
Yeah, absolutely. If you had kind of staggered these or you had them laddered in some sense, and that would assume that lower level pool was out of range when this other one was in range. Now you have more ETH. When you put this into the pool, you have to have a subsequent amount of USDC too.
Right.
So that also probably assumes that you have some USDC on the side. But absolutely, you could increase the size of those pools. And through this, you'll see that you can add liquidity. So on the screen here, we've got the ability to add more liquidity. So if I had another $100 in USDC, $100 in ETH, and I want to size this up to a $500 pool, I can do that just simply by clicking Add Liquidity, and it'll ask me how much I want to add. If I want to remove all the liquidity within a couple clicks of a couple buttons here, we can take out the whole pool itself, 301.66, and the fees at the same time, all in one fell swoop. So you can manage it that way. Or, the other thing that you could do, let's say everything's working perfectly. This thing's just chopping sideways. You got a great pool. It's running hot. You've got all these fees. You might want to keep this going. You could be 50-50 and have $100 worth of fees. Collect your fees, put them back into the pool, compound those returns. So there's a few different strategies here, but when you get those big volatile moves, and that's what you're up against, right? You're implicitly short volatility, but you want a lot of trading activity. That's a great environment when it happens, but quite often when volatility shows up, you get these big moves that push you out of range. And so you do have to kind of battle with that a little bit, and that is the risk here. But in an environment where it's just chopping along, and we've seen that. I've seen it where it's done that for months at a time. Good example of that was probably the period almost from March to August, March to July of 2023. I mean, markets were just kind of dead, going sideways, and really we didn't see much change until probably October, November of 23, and then we got the ETFs in 24. But that period was fantastic for liquidity pools, even though it was an extremely boring and semi-bearish environment for markets.
You're making your ETH work for you.
Absolutely.
So are you also staking ETH?
Not really. No. I mean, I have some staked ETH, but most of what I'm doing with ETH is in liquidity pools, or I'm just long. You're long when you're staked, but I'm just doing more with it on Uniswap.
Lone Sophos has arrived late. Hello.
Welcome.
And Edward, Hope and Pray. I think that's called HODL. Yes. Diamond hands.
Yeah.
These are sparkly.
Yes.
I have held a lot of things.
Everyone thinks about that on the way down, though, but it's much harder on the way up, especially when you have the volatility that's associated with some of these assets, because that's where you make your money. It's not so much like, okay, can you withstand the downturn? Sure. A lot of people do that just simply because we're stubborn, but it's on the way up, right? It's really the exercise is not selling too early, given the volatility is greater on the upside. And it's hard because that's not how traditional markets trade, at least equity markets. And so that's where I think, diamond hands matters. And I suppose that's where it always was, and, what it is really referencing when you go back to holding the upside in GME or AMC or something like that with the meme stocks. But yeah, that's probably the hardest thing about crypto is timing the upside. It's not so much like picking a bottom. It's, do we get out here at this pretty significant, short-term move, or are we holding for something bigger? And then you get burned doing that too,
Oh, I know.
Yeah. Well, that's going to do it for our show. Shelly, thank you as always for coming on here and joining me on the show on Wednesdays. We've covered a lot. SWE, Aptos. Make sure you check out the email this weekend for more on those tokens and some of the tech behind it. We will continue to put some guides together and do more shows on liquidity pools. We've got some cool features coming to the Tasty Crypto Wallet app as well to help make this easier for everybody to do.
And we have a big reveal on Friday on Beans.
All right. Tune into Beans.
9 a.m. Central.
Only on Tasty Crypto.
That's right.
All right. Yeah. If you're not following us, subscribe to Tasty Crypto and make sure to check out Beans. And when you tune in, smash that like button, as they say.
Like and subscribe.
Hell yeah. That's going to do it for our show. I'll be back next Monday with Shelly. Shelly will be back on Friday with Beans. Don't miss it. Victor Jones is up next with The Price of Truth. Until then, I'm Ryan.
I'm Shelly.
Peace.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
How much does it cost you guys to do simultaneous hair flips?
Years of practice.
Everybody wanna be like me, yeah.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20.
If you missed the live show, here's our cherry on top weekly recap.
You became Chicago's most eligible bachelor. What year was that? That was the debate we were having earlier while you weren't on the show to defend yourself.
1988.
88. So Vanetta was right. Late 80s, early 90s.
You mean when I was on the Oprah show?
Yeah.
Yeah. Well, 88. I had flowing locks like Tom.
Oprah just made it.
Oh, here it comes.
I mean,
she felt bad. She felt badly for him. You couldn't get a date.
You get a car, you get a car, you get a Scott Sheridan, you get a Scott Sheridan.
I want the car.
That's right.
Oh, yeah, it's Wednesday, Wacky Wednesday, as some would say, March 26th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, and because it's Wacky Wednesday, it's also time for a little bit of man cleavage by our good friend, the one, the only, the big brain here at Tasty Live, Chris Vecchio. How you doing, my friend?
I thought I dressed appropriately for the show.
No.
The cat calling won't stop.
Now.
The cat calling won't stop.
What's up, man? How are you? It's great to see you again. Hey, I was talking to Ilya yesterday about this whole 23andMe thing. He brought it up in the green room, and I thought it was kind of hilarious. Did you do that thing at all? Maybe 23andMe. I think there's another company, another one or two companies. Did you do that gene thing?
No.
Good, man.
No. What's the appeal? I've been to Ellis Island. I've done the research. I know my family goes back to like 70 BC. Okay? I'm good. We're Italian.
Technically.
Got it. You see these eyebrows? Okay? We didn't need to ask.
Technically, you go back further than that. I said the same thing, dude. I was like, I'm good. My grandmother told me where it came from on one side. My grandfather told me about our family on the other. What the hell do I want to send my DNA into some corporation for? What is the value proposition? And why would I be paying them? Shouldn't they be paying me? I didn't understand it.
I don't understand it. And now some private equity company will know everything about you.
Congratulations. Play stupid games, win stupid prizes. Chris Vecchio, there's way more important things to talk about today. We used to say what's up to the people. tastylive.com. Shout out to all of you watching there. Shout out to all of you watching on Tasty Trade desktop and mobile application. If you don't already have both, go get them. But if you want to be part of this chat box on your screen, did we get it? I don't know if we got it. In the middle of your screen, there's only one place to do it, and that's on Tasty Live's YouTube channel. So head on over to the evil Google YouTube. I should stop saying that. If I want to make it past the purge that's coming, I should probably start paying allegiance to the New World Order. But if you want to,
wait, isn't that what you're doing by calling Google evil? So whose side are you on then?
I get what you're saying. It's like the whole satanic, support and ritual.
You're either drinking adenochromosomes or you're not. Which side of the table are you on?
Somehow that was us promoting the Tasty Live YouTube channel. So
come get your Tasty Blood Boy at tastylive.com/merch. It's the type in code Brian Johnson for 40% off your next order.
Bro, I'm dead. I'm not going to make it through this episode. If that's what you're bringing on in the first 60 seconds, start banging your phalanges, your metacarpals, your skull, anything against the keyboard, spoof the Google algorithm into putting us in front of as many people as possible. And either, getting a bunch of people denied at the purge, or perhaps we'll somehow get each other across the finish line. I'm not sure. Chris Vecchio, S&P 500 down 1%, NASDAQ down 1 4/5%. The Dow Jones, I'm contractually obligated to mention at the top of the show, down 1/3%. The Russell down 1%. I don't know, man. There's probably a bunch of people running around, again, chicken with heads cut off today. But I think, we've sort of, if you just picked up John Murphy's technical analysis book and you had just read like the first chapter, like if you literally only read the first chapter of a technical analysis book, yes, the OG book.
This one? Okay.
It's somewhere in there. It says previous support becomes future resistance. I think it's right after primary and secondary trend.
Right there.
Yeah. And I know, the access to information, all the headlines that can make it seem quite crazy. Tell me, Chris, is this a technical rejection of a 5,800 level that we sort of knew, 58 to 59? We sort of knew this is going to be a sort of a choppy area. Is this a simple technical rejection? Are we still playing cards? Or do you think something more meaningful happened today in both the data releases we saw earlier this morning and some of the announcements, the tariff announcements we saw later in the day?
So setting aside all of the news, the noise, the data, let's just think about the charts from a pure price action perspective. The rally that we've seen off the lows in recent weeks has shown some signs of improved momentum. There have been turns in various momentum indicators. And through this turn that we've seen starting March 14th, when we closed above the prior day high as well as the 1 week moving average, two events that had not occurred since in tandem February 20th, you had a chance for a bounce. Now, where does this bounce lead us to? It brings us back to some of the swing lows that you see, at least in the ES-M5 contract that you have carved out in September, October, November, for example. And what do we also have up in that area? Our 1 month moving average. And what do we do up there? The last 3 days gives us an evening star candlestick pattern, which is a 3-candle topping pattern at former support turn resistance and our 1 month moving average. Now, from a pure price action perspective, that kind of situation tells you what? It's a sell the rip, not a buy the dip kind of environment still. I think about what I would do if this was a mirror image scenario. If the S&P 500 had been rallying, experienced a 3 to 5% pullback, and at its 1 month moving average, established a Morningstar candlestick reversal, right? Big down bar, a doji or a hammer, and then a big up bar. I would be out here if it was 2023 or 2024 saying, that's it, green light, time to get back on board. We're going back to the highs. So if I'm going to be intellectually consistent, I have to say from a technician's perspective, this looks like an absolute nightmare. It looks like it's the end of the correction off the lows, and it's the beginning of the next wave down towards the low that we saw plus steeper lows beyond that. And if that were to transpire, right, if we were to see the NASDAQ pull back here, lose its uptrend off the recent swing lows and break through the low that we had for this year so far, I have a target below 18K outlined. It's closer 17,700, 17,730, depending upon where, or 17,300, depending upon your exact measurement points. But it begins to look very slippery very, very quickly. Again, purely a technician's perspective.
Yeah, I think like early this morning, like right at the open, not much was happening, but very, very quickly, Nvidia was down, 3-4% early this morning. Tesla was down like 6%. And I thought, we had said this maybe last week, that when you get down to 5,500, for whatever reason, I thought that might be a decent value area. And I also thought the range that we were going to be in was going to be wider than the 6,000 plus or minus 200. So you get 5,500 plus or minus 300, which means there's a potential for us to go test 5,800. And the hard part about that scenario is once you get there, 100% the narrative changes. They're all going to say it was a growth scare. Vol's going to have plummeted at that point in time. and you have a choice to make. You have a choice to be sort of disciplined and take some deltas off the table, or at least sort of be cognizant that you're probably not this is going straight to a new all-time highs type market. And because you probably got a little bit of excess to blow off there, 5,800. And then the question becomes, were people, are there big players in the market who are just looking to distribute stock? Like, do they still have excess inventory of NVIDIA they want to pitch, and the Tesla they want to pitch, and Microsoft they want to pitch, and all this stuff that all this excess liquidity has just been draining straight into U.S. stocks, in particular the Mag 7? Is there additional inventory to distribute, and you're just waiting to, it's like in poker, you just string somebody along. You're trying to get the max value out of your opponent. So you let these things sort of float as high as they can before you distribute again. And today, it kind of looked like there was more inventory. You can point to all the articles you want to on NVIDIA, point to all the articles you want to on Tesla, but we got to a point where you'd probably strung along your opponent as far as you can, and it's time to distribute. And now the new question comes, Chris, is how much is behind this? Do we trade sideways from here? Is there a choppy two-way market, or is there a lot of inventory still here to be distributed? And I think that defines whether or not, or how you're playing this on a short-term basis anyway. How are you playing this on a short-term basis? I know that's not necessarily what you do. You're not necessarily a short-term swing guy. But how are you playing this positionally?
So right now, at least for stocks, I still have one short put spread on in ES. I've only been nibbling this year. I've taken a few small shots, and I took another small shot on March 14th with the short put spread. So I'm going to hold on to that for now.
Short put spread in ES?
In ES, yeah. And it's working. It's still profitable. The gains that have been accrued have been effectively cut in half after today. But I find myself, thinking about what happens next in terms of the economic data, because I think the economic data confuses people. It certainly presents a confusing narrative, right? Durable goods today, for example, come in much hotter than expected. Mm-hmm. And when you look through the data set, you could still see that it looks like people are pulling forward spending because of the potential tariffs. And, vindicated point of view, by the way, Sunday, what do we have going into the market this week? Tariffs on April 2nd are going to be narrowed. Autos and semiconductors are going to be exempted. And then what do we hear today during the press secretary's conference? Oh, yeah, by the way, Trump signing auto tariffs at 4 p.m. Mm-hmm. So, yeah, I think the point of view that why are some of the spending figures, holding up? You have to look to the import-export imbalance right now. The import-export imbalance has surged for two reasons. One, our imports are through the roof. People are buying a ton of things before prices go up. And then, of course, there's the gold factor, which I guess as a little bit of a non sequitur. The Atlanta Fed GDP Now released their growth update today. And I think over the past few weeks, we've talked about how they've had to account for gold imports. On the Atlanta Fed growth tracker now, there is a gold-adjusted GDP estimate because of how significant of an issue they find this to be. So stripping this back and going back to the whole point, people are spending money because they think that prices are rising in the future. This is what happens with an inflation spiral. You think prices are going up, so you spend more now. You actually create more demand bottlenecks. And so producers do the thing that you were fearing they were going to do. They raise prices to capture the surplus. I find this troubling. I find the Dallas Fed Manufacturing Survey responses today troubling. Not exactly known for being a bunch of woke commie libs, those oil refiners, right? And they said it's the worst business environment that they've been in the 40 years in the industry. So if we're going to see a slowdown in spending, a slowdown in investment, people don't know what kind of capex decisions to make, when and where to source goods or raw materials. The hard data is going to catch up at some point to the soft data. There is a big divergence right now. We can't ignore that. The surveys are terrible. The hard data is holding up, but I think the hard data is holding up because people are front-running a freeze in their spending in 2Q and 3Q, and that alarms me. So, yeah, I have my short put spread on right now. I don't love it. Today's price action, if I was putting capital out fresh, I would not be putting it on for again. So tomorrow, I suppose, is the line in the sand. But, VIX stocks just opened up, 19 minutes ago? S&P's off by 0.41%. NASDAQ's down by 0.49.
Still ugly.
Still falling after the close. after Trump speaks in between the sessions?
Vol up today. VIX futures up to 1915, VIX up to 1833. If anything, because I didn't get short, I think a couple people in the chat probably called this exactly right yesterday with looking to fade it today. I thought maybe we could press a little bit further. If I'd done the work, I would have seen 58.35 as sort of the more specific line to be paying attention to, which is sort of where we turned around. But I thought anywhere between 58 and 5,900, and yesterday I talked myself into the market pressing up a little bit higher into 59. That said, at 17 and change in vol, it's yesterday for me, but earlier today, the one good thing I could say is I bought vol on a lot of my biggest long positions, and I bought some downside puts in the S&P and the NASDAQ. Not a ton, though. Not a ton to be like crash insurance for the portfolio, which I'm now kicking myself over because I probably, if this goes anywhere, I'm probably not going to get a better chance. Though I'm not convinced, Chris. There's some part of me that's not exactly convinced that this thing falls like a hot knife through butter straight through our previous low at like 5,600 or something like this. I think we could still be in choppy territory, though. I don't know. I can change my mind on that.
I mean, how difficult is it going to be for stocks to rally when the Mag 7 is still struggling the way that it's struggling?
Yeah.
Right. And this is a point of view that I was talking about with Tom on last call and with Ilya and Dylan on overtime. And so the fact that the market's down 0.5% here immediately after hours isn't shocking to me. But the economy, the stock market cares about one thing. We ended the show with this last week. It's a discounting mechanism, all future cash flows, and doesn't care about anyone's politics or policies or anything else unless they relate to those cash flows. And levying 25% tariffs on autos is going to raise the cost of, upfront, maybe a tool to try to get people to bring back manufacturing here. But again, manufacturing factories just don't open up like that. They take months and months to build out. So we raise these tariffs. There's no go-between. Prices go up. Auto analysts across the board, it doesn't matter where you look, are estimating somewhere between $7,500 and $12,500 increased cost for a new vehicle here in the U.S. And every piece of data that we have in history that models out what happens when tariffs are raised on specific raw material imports, the people that process those, like the steel manufacturers, the Alcoas of the world, the U.S. Steel, they're fine. But if you use steel or aluminum as an input to your business, you make cars, you make beer cans, okay? Your costs go up. We know this. We don't need to relearn these lessons from history, but for some reason we're going to try to do it again here in 2025. So as a discounting mechanism, are corporate margins going to be smaller in the future? Maybe, right? They pass them on to consumers, yes, but at the margin, consumers right now who are already overly indebted, auto loan delinquencies are going up, credit card delinquencies are going up, student loan repayments may be defaulted now because of what's been going on with the DOE. 9 million borrowers are now seen as in default because of some of the actions taken over the past 2 weeks, which, again, how does that impact people's spending? Yeah, maybe equity markets should take another dip to the downside before recovering and we wash this out. If only to put a finer point on this, positioning in the market matters a lot right now, okay? During the downturn here in stocks, speculators got longer. And that, I think, is a really surprising development. We were net long in the middle of February, and we've gotten more net long during the decline. Speculators, non-hedgers in the futures market, tend to be trend chasers. And so the fact that we didn't see a liquidation during a 10% pullback in stocks where traders decided to go from net long to net short says that there are people who are stubbornly holding on still. And that means there's more pain ahead. There could be more pain ahead. There's fuel to burn if we want to move to the downside.
That doesn't surprise me at all. That the data validates sort of what it felt like. When it felt like and seemed like on the screen anyway, that there was like the vol backwardation came so late. It wasn't like there was fear and then people puked or anything. It was like, all right, we're down 10%. I'll do something just in case. It felt like people were opportunistic They were a bit bearish, but opportunistic the entire time of that 10% correction. And this is why it becomes really difficult. Yeah, do I think we need to have more pain? Are we still overpriced? In my personal opinion, yes. But there's such a gigantic demand for assets right now. And you talk about the consumer. I still think it's very difficult to talk about the consumer as sort of this individual or aggregate, because that couldn't be farther from the truth. There is one consumer who represents everything you just talked about: the $1 billion in credit card debt, the behind on the student loans, the worried about keeping their job and paying even an already low mortgage, suffering because of higher insurance costs. Then there's another consumer, dude, that this is not touching. They're getting paid 5% to take no risk in a market. Plus, they've had massive capital appreciation over the last couple of years. 20% annualized NASDAQ returns. Those people do not give a shit about higher pass-through costs. Luxury goods are not going to suffer, but what will suffer is all the shit, like the Dollar Trees and the Dollar Generals of the world. That shit is going to catch the squeeze. So I agree with you. I definitely agree with you in general, but I do think it's hard to talk about an aggregate consumer. I do think it's probably worthwhile for mental models to break those consumers out. And I think you're going to see in this world less pressure on those sort of the luxury goods part of the world, especially the ones where people aren't stretching into, There's lots of times where the lower end consumers stretch into purchase of upper end consumers, and that probably is still a recipe for disaster and needs to have some pressure. But luxury goods, bro, on the margin, I think are probably fine.
You know what's interesting about this whole saga, and probably why it throws people for a loop and it makes people so uneasy around these tariffs. I saw a poll yesterday from Echelon Insights. Echelon Insights is a right-leaning pollster. They are friendlier, and we talk about bias as in they tend to skew more towards the right in their results. Jeff Joseph and I talk about this a lot in the prediction trade. We've talked about different types of pollsters and how you can view them on the continuum. It's not to say that they're going to give you more favorable results for Republicans and Democrats, but they tend to lean that way when you look at the aggregate of polls. The point being is, again, not exactly a left-leaning group here. They put out this poll yesterday. Voters say Trump is most focused on immigration and tariffs, but should be focused on the economy and inflation, right? Voters say right now Trump is most focused on 25% immigration, 16% tariffs. Trump should be most focused on tariffs. Doesn't make the top 10 responses. The top response is the economy, 38%. The second is cost of living inflation, 20%. Now, I know that you and I would argue tariffs are the economy. Tariffs are related to cost of living and inflation, right? But there seems to be a mismatch here between what the stated goal is and what people are actually thinking that's happening, and that is what's causing the friction right now. And it looked like earlier this week there was no friction, right? Hey, listen, we're trying to accomplish this return of American manufacturing, but listen, we understand it's so disruptive. We're going to narrow these tariffs. We don't think it's appropriate to do it in semiconductors and autos. We get it, right? And why does the market respond so positively Monday? It seems like, okay, they understand. There's a direction here. There's a North Star now. They're doing this, but with a purpose, with a scalpel, not a sledgehammer.
I don't think that was the reason for the rally, and I'm not so certain this is the reason for the sell-off, but go ahead.
It feels like we were turning a corner there in terms of understanding, is this Fortress America? Is this trying to create a unified world against China? Is this to replace income taxes? We were getting away from the Calvin Ball, Michael Scott snip snap aspect of it, if only for a brief 24-hour window.
No. We're not getting away from that.
No, we're not.
I'm telling you, bro, like everyone.
My bad. Boy cried wolf. I got caught.
Yeah, because when on the upswing, it's going to feel like everything's behind us now. You get what I'm saying? But on the downswing, it's like, oh God, again. But we're not out of that. And even April 2nd, they've positioned it, man. If you read between the tea leaves, it's not like some grand plan is going to come out on April 2nd. The way they've positioned this thing is, okay, we're going to pull out some products. It's not going to be across the board. So they're basically lining this up to tell you, here's a little tiny piece on April 2nd, and there's going to be another April 2nd. They like to time box these negotiations. They think it puts their counterparty in the negotiation in a more difficult position. They think it moves the negotiation. I'm guessing. I'm speaking as if I know. I don't know, but I'm guessing. And I think that's what they're going to keep doing. And I also think that Trump, I'm going to explain what I think this is. Immigration is a distraction. Immigration is a distraction to the people. It's really easy. Politically, this has happened. I mean, this has happened a countless amount of times, but people keep falling for this. That whenever we get into these economic difficulties or high levels of debt, you just blame the immigrants. And so it's so easy to go deporting people, and that's all you see on Fox News or that's all you see on NBC or whatever. It's all about this immigrant story. And the reality is something completely different, right? The reality is the money. But it's easy to keep throwing red meat at the base and talking about immigration. And the tariffs, I think, he doesn't want to link directly to inflation or the economy. And that's for strategic flexibility. I think he's a guy who doesn't want to put too many of his chips on one number in the eyes of the public. And that allows him to change his narrative later on. It allows him to change his negotiating tactics. And so if he comes out and he says, I need to do this, I'm doing this to renegotiate this, that, or the third, and it doesn't work, well, he's stuck in that narrative. He can't change his narrative. He can't change his negotiation. So this is like part of his style. I'm not saying it's good or bad, but that's how you get. Why the hell is he over here doing all this shit with the tariffs, causing the market to go up and down? And he's talking about these immigrants. Meanwhile, I'm worried about the economy and the price of eggs haven't gone down. I say that, but I think they have gone down like 50 or something like this.
Yeah, they're down a lot now. I think they're down below $4 a dozen now.
Yeah.
It's like $3.90, I think. I tweeted a chart earlier. I completely disagree with everything you just said.
Okay. In what way?
This is a long-standing American problem throughout history where we have a gut reaction to people who we perceive to be those who may undercut our wages. One of the big problems having now, I'm working my way through a Teddy Roosevelt biography right now. So I've made my way from 1753 up until about 1904 right now in American history. Over the past 8 weeks, I've read 14 books. You can see the contours of why in the founding era we immediately obstruct or construct barriers to entry for non-white Europeans across the world. Okay, there is a distinct, even among people like Patrick Henry, great founding fathers, they see that the influx of foreign immigrants who are willing to work for lower wages than Americans could hurt the labor market. You see this after the Union wins the war. One of the rationales for Abraham Lincoln being shot and the entire conspiracy around it is that Abe Lincoln is allowing the integration of a workforce that's going to undercut white farmers' wages in the Reconstruction era. You could see this around the turn of the century when you have the Transcontinental Railroad being built. People were very against having Chinese workers come in, but you had American engineers and business owners saying things like, well, didn't the Chinese build the Great Wall of China? Like, they probably know how to build stuff. And so, they brought in all these Chinese workers. And you see this with the Italians and the Irish. And then you see this in the 1950s. I haven't quite got there in my American history refresh, but from my knowledge around the Civil Rights era, a big part of the reason that the Democratic Party split apart were Southern conservatives leave the Democratic Party and join the Republican Party is because of the influx of women and minorities into the workforce. It's going to threaten laborers in the country. So I just see this as like a nativist impulse. It's easy to play on because it's ingrained in our history. This has been here from day one. You can pluck the fiddle of immigration and you can get a very significant response to it. And it only works, by the way, when people like Trump or DeSantis do it, and it never works for Bernie Sanders, even though Bernie Sanders has said things along the lines of, immigration is a real problem. It is undercutting workers' wages. He said as much this week, didn't really get a blink or any coverage in mainstream media. But it's because if you're going to be populist, on the left, if you're anti-immigrant, that kind of betrays your universalism type of view, where people are people, regardless of where they come from, their religion, their creed, their nationality. And so kicking people out based on the color of their skin or what border they've crossed kind of is a betrayal of your own values. But right populists can go there. They have no problem going there. They have an easy solution for that problem. Your wages are being undercut. Get rid of all the immigrants. Thin the labor pool out. So yeah, I think immigration is actually the issue. It's been the issue in America for the last 250 years.
Okay, a couple things. I definitely appreciate the perspective. I would push back on a few things.
I'm probably wrong.
The first thing I would push back is I think it's overly simplistic to call it a nativist impulse. The laws of labor, like supply and demand, would say you're wrong. The laws say you add supply somewhere without changing the demand, and you're going to have, the price of that thing is going to go down. So the price of labor goes down when you significantly increase labor supply, regardless of how those people get there. So I think it's not a nativist impulse, and I also think we purposefully have left it broken in our economy. We purposely have left our immigration policy broken. Why? It would be much more straightforward if we had very clear, straightforward border policy. Why? Because then an immigrant would know, let's say we had a point system or something like they have in Singapore, it's called Compass. You can literally know based on your racial and ethnic background, your demographics, based on your education, based on the type of job or type of work you're looking for, based on the skills you bring to the economy, based on the wages you've earned previously, you will know, you kind of get a score. And then based on what that local economy needs, if you have too much of a labor supply already, or you don't have enough of a certain type of labor pool, it's a bit of centralized planning, but they're thoughtful about the immigration they let into the country. We're not like that. We kind of leave it broken, but we have some protections, right? So we open up the border for 10, 15, 20 million people, right? The likelihood that doctors were crossing the Darien Gap to get in our southern border, very low, right? So the skill set of the new labor supply is likely going to compete with a group of people who are already being marginalized by existing capitalist economic system. It's not a nativist response, dude. It's a response of a group of people who are already threatened by technology in their local economy. They're already threatened by the lack of resources or the cutting of resources in their local economy. And now you're adding to that labor supply, which now spreads across the existing resource, across more people. It presses down on wages of the labor supply. It's not a nativist response, dude. It is a real and rational response to what is happening in the world around us. That's number one. And number two is we don't do anything about that. We could create a point system that makes it straightforward, but then what happens is when you increase the money supply by 40% over 2 years and you go, if we don't do something about the amount of people working in this economy, we've got to pay these people. And if we don't pay these people, we got a revolution on our hands because we just devalued the price of money by 40%. And I think, so what do? We're not having kids. Well, we got to let 20 million people in. Otherwise, we got to pay these people. And you don't want to pay them. And
Vic, this is the point that I'm getting at, though. You just highlighted the inconsistency there, which is that we know there's a problem and we allow it to exist. And the people who talk about this, they understand people's sentiments. And so they create this nativist arc. These people are coming in to take your jobs, even though the people who are making these claims are the ones that allow these laws to exist and persist. And I think the bigger issue here, and this is really the fundamental problem with immigration in the United States these days, the systems that we have set up that were agreed upon, right? The structure that we have right now is a George W. Bush era policy that was explicitly designed around stopping illegal immigration from Mexico, right? The laws that were never ever constructed to address illegal immigration coming from Central America and from South America. So we have right now an apparatus that's designed to deal with a very specific, narrow issue. And we have an entirely different problem at our hands, and it's overwhelming and flooding our system. And as other people have pointed out, if you add the population of Pittsburgh to the United States every single month for a year in a row, it's going to cause dislocations and problems. I've said with you on the show before, it shouldn't take Greg Abbott and Ron DeSantis busing 300,000 people up to New York City, forcing a strain on local resources, removing available supply of hotel rooms, which inevitably pushes up the existing supply for tourists that want to come. Tourism is the boom engine of the New York City economy outside of finance. And so if you're going to remove available hotel stock, you're going to hurt the broader economy, which means you're reducing tax revenue, which means you have to cut services more. And Eric Adams isn't the most popular guy. And Eric Adams, and with this whole immigration situation, has done such a crappy job that someone of Andrew Cuomo's stature, with all the allegations and attacks against him for the things that he's done inappropriately, and I say that with full confidence, knowing some of the women personally that have accused him, and I've known the governor for a lifetime. My mom has worked on the lieutenant governor's campaign for his father when Mario Cuomo was in office. Okay, so like there's a long tie there, and yet he's the guy who's rising to the top. New York City is such a mess right now, all right, for these very reasons. And why did it take this? Why did we have to see funding cut for the homeless? Why do we have to see even discussion about cutting education for schools in New York around this issue? So Democrats never woke up to it. Immigration is a real issue, but I think the people who use this as a wedge give literally two shits about this people that it supposedly affects. What's the answer here? We're raising these tariffs and cutting immigration, and what have we done this week? More farmer bailouts? I'm sorry. No one wants the handout. No one wants the handout of, we know you're struggling, take this because we did something that screwed up your business. Here's a bunch of money to shut up about it. This will make things better.
Yeah, our farmers got pissed the last time. Just to make sure we're not talking past each other, I started this by saying immigration is a distraction. And I think you said I disagree with everything. You gave me your points. I gave you mine. I should clarify what I mean by that. Okay, immigration wasn't the start, in my personal opinion. It was we increased the money supply. We devalued money to such an extent, and we're unwilling to deal with the consequences of what was going to come with that. We were unwilling to let the labor negotiations play out as they would have normally. So in my personal opinion, the immigration policy was 100% on purpose. And now what's happening is the focus of the current administration on immigration through the lens of deportation is just red meat. It is a distraction. If you wanted to actually deal with this problem, would we be putting budgets in front of people that actually increase the deficit $2 to $3 trillion? No, we wouldn't. If we wanted to actually fix this problem, would we be working on new immigration legislation that puts together a clean and clear immigration policy so that we're going to have this argument right now on deportations about, these people have already been here, they've set up shop, they're hardworking people, they haven't committed crimes. And so it's this empathy game, it's this moral game, instead of let's just create something simple so that the people who are coming here know that they'll get to stay here once they're here, and the people who are in the country get to hold their elected leaders responsible and accountable to the immigration policies that they're setting and the levers that they're pulling. But we have neither of those things, and which is why I'm calling this whole thing about deportation right now, it's a distraction. That's where I started. So I got a question. I think we may be in the same ball.
We may be, right? Like you're saying it's a distraction. I'm saying that they're using it as a distraction, but I also think it's a core issue. It sounds two-faced. I'm curious, when was the last major immigration bill set forth that had bipartisan support in the Senate and the House?
I have no idea, honestly.
Last year, Senator James Langford from Oklahoma had a bipartisan bill, and I don't remember why it was tanked. But no, why was it tanked? Why did the House pass? Do you love the talking point? House passed it. The Senate was ready to pass it. Why didn't it pass?
And by the way, I like the discussion today. It was tanked because the narrative is it was tanked because Trump called all the people on one side of the aisle and said, tank this bill. It will favor them politically. It will help them into the election. So let's not pass this. So here's my question to you. if I go a step before that and I say, and by the way, that immigration law was horrible. I mean, the idea that we
didn't say it was a good one.
Yeah. So just because it's bipartisan does not mean it was actually a bill that was going to fix our broken immigration system. Let's start there. It was a shitty bill. The second thing is the premise for needing to pass that shitty bill is that we need the president, the executive needed new authority granted by Congress in order to fix the immigration problem. Right now, where are border crossings? And did any of that come with new executive authority? No. So the point was,
yes,
he could have done something about this. He didn't do anything about this.
We just the new continuing resolution gives him the authority now to do it.
No, my point is where we are now in immigration comes because of the positioning to the world about how the U.S. is thinking about immigration, and also what you do, how these guys are handling it. Again, I'm not pro or anti-immigration. All I'm saying is that the politics behind this, the politics behind it on both sides are disingenuous. That's my point. It was disingenuous for Biden to say he needed new authority to do anything about border crossings, and it's disingenuous to pretend like deportations are somehow going to fix this problem, or disingenuous to say you're going to deport. Are you going to deport all 15 or 20 million people? You're not. You're going to deport like 2 or 3 million people, enough to make people to feed red meat to the base, and not fix the actual underlying problem. That's my point.
How long of a timeline do you think? Let's just say they're going to deport 3 million people. Right now, they're according to ICE data maintained by the Trump government, they're at a run rate slower than what Biden did last year. It's just it's their numbers. So like to get to 3 million people, you're going to
only say 3 million. I made a guess because that was the number for the Obama administration.
Right.
I think first term. And so I'm just making a guess that they'll be in that ballpark. My point being, this is it's all smoke. It's all smoke.
I mean, I think one of the big problems that I see a lot of people having with immigration these days is the lack of assimilation that occurs. And you and I have gone back and forth about this particular issue. You go back 20 years and you read Audacity of Hope by Barack Obama.
Yeah.
And you'll see that he has a whole section about how he's bothered when he goes to immigration rallies and sees people speaking Spanish and waving the Mexican flag, which I also I think that also, by the way, as an insight into what the issue of the time was. Like this book is written in 2004, 5, 6, somewhere around there.
Correct.
Like
you go to after the Clinton. That's right after the Clinton administration, which was notoriously sort of anti-immigration because, again, at the time you had a much stronger unionized workforce. You had 20% of the population in the late 80s that was under a union, and a union is going to help to teach their union members about labor supply and how increase of supply changes.
Did something happen in the 80s?
Wages.
Thatcher, Reagan, the emasculation of unions. Did the neoliberal wave that started with Carter and then accelerated with Thatcher and Reagan, did that have anything to do with the decline of unions?
And you made this other point, which was about left and right populism. And to me, that's the game. That the whole game is the left to put if you're populist, you kind of have to understand that you're not a left populist or a right populist. If people could sort of understand that the whole point of dividing you will then minimize your political power and then perpetuate the conditions that created the knee-jerk reaction for the populism. Populism isn't just a thing somebody runs on, right? And then there's this big
no,
because I sold it to the public. There's an underlying condition there that can be utilized for the purpose of political gain, but it's how did it get there? What is the underlying cause? And it's taxes and money devaluation, man. At the root of all this shit, it's an unfair tax system and money devaluation. And instead of going and addressing the taxes on wealthy, we instead want to implement tariffs, which is effectively a consumption tax, but it consolidates power in the hands of the government to utilize for their own control. And it's like, okay, we can try it this way. We can try it this way. Maybe we'll get a little bit, a few more manufacturing jobs in the U.S. and congratulations, but you've still got the same exact goddamn system that got you the populist uprising to begin with.
What's the old expression? The boss makes a dollar, I make a dime. That was a poem from a simpler time. Now his boss makes 1,000 while I make a cent, and he's got employees that can't make the rent. When the CEO makes $1 million and we don't make jack, that's when we riot to take it all back. Now, Mr. Investor, if this seems extreme, I have to remind you it beats the guillotine. Right? Isn't that how the poem goes?
Speaking of French revolutions, let's talk about bonds, man. That was who was that by the way? I don't remember that poem.
Jimmy_cognac on Reddit. I just Googled, I remember the poems. I Googled the full poem, and you always Google something Reddit because you don't trust anything pre-2018. So your Reddit's my source. Jimmy_cognac. Thank you very much.
Here I am thinking because I'm sort of I'm insecure about my educational background. So I like you, I read a lot. And so I'm always a little bit insecure when somebody brings up a passage that maybe is a classic literary work that I'm not familiar with. So you just had me thinking like I was a little ashamed and embarrassed, but I had to ask. I'm not going to pretend like I know it. So who was that by? Some guy on Reddit.
It's by.
Who's it really by?
For Chris Hart.
Okay.
Who dat?
I'm going to move on real quickly I think the more interesting conversation, we barely talked about stocks, which I want to try to get as much out of that as possible. But really quickly, bonds 116. What's happening in the yield curve in your opinion? Is there anything interesting happening in the yield curve in your opinion? We've backed off a 119 area in the long end, which means the long end of the curve is lifting. Some part of me goes, what is this? Are we pricing out the growth scare? Are we pricing in inflation? Are we effectively pricing the cut that is coming in June, and the bond market is sort of adjusting to it or anticipating it already? What do you think's happening here in the yield curve?
It's a really good question. It feels like it's a market that understands that a sell-off or rather a deep retrenchment in growth up front is not likely. So the recession fears have been squeezed out of the market. Again, how many times have you seen recession start with this huge surge in imports? But this may be a unique time. This may be a really unique time. And there are regime changes in history. Now, I know like seminally, regime change is something that you equate with like political regime. But in fact, the origin of regime change comes from people discussing economic regime changes. When you switch from a society that's effectively run through a classical liberal economic system that morphs into Keynesianism and then ultimately morphs into neoliberalism. And we could be into a turning right now where we're moving from this post-Cold War neoliberal globalized effort into something that seems familiar but is also uniquely distinct from anything we've ever experienced before. Because every other time we've had a regime change economically, the United States wasn't necessarily the top dog in the land. The switch from mercantilism into classical liberalism occurs after the United States effectively takes down Spain in the Spanish-American War. And that continues for 20 or 30 years until, of course, you have a series of booms and busts from the railroad crashes to the fact that there's a lack of recovery in Europe immediately after World War I to our own boom in the 1920s and then Great Depression in 1929 going into the 1930s. So if this is a big turning point, what system are we evolving into where we have a good guide for the future? Are we going back to something mercantilist or something more that's like an autarky, or trying to fit a square into a circle not going to work because the world has changed and we can't just unwind the clock and become isolated? I think this is going to be a very volatile market. So I want to just go back to a bigger like North Star kind of idea that I have now based on the past 2 days of consideration. Yesterday, when I was on with Nick Batista on Futures Power Hour, we highlighted in the top of the show the VIX term structure, how it returned to contango. And I was making the point that it almost feels like that doesn't feel appropriate given the fact that we have a system right now, a market, where a feature is that we have tape bombs. That's not a bug. It's not like, oh gosh, Trump said something? Where did that come from? Right? This is a what's Trump going to say today kind of mindset. And if that's a feature of this environment, then should we have a market where you're looking at a VIX that's in contango all the time? It feels like if it's a sell the rip then buy the dip, then when vol comes in and markets rally, you use it as opportunity to buy protection, buy some puts. A world that makes sense to me is a flat VIX curve, right? An inverted, a curve in backwardation means there's a lot of risk up front right now, and that's panic. I don't think we're in panic right now. But a flat VIX curve, that makes sense. So the question was about bonds. What are we doing with bonds here? I don't know.
I like where you took it.
I don't know where we're going with bonds. I still have my long deltas on. I've had them on for a few weeks. It's been like just a frustrating trade because nothing's really doing. Long Z and call spreads, short Z ZB put spreads. If growth is going to fall off in 2Q and 3Q because of the spending issues, then bonds are the place to be. Gold's the place to be. If we're seeing the worst first quarter GDP figure ever in terms of clarity that it provides, then bonds could actually get smacked down a little bit more because it looks like a near-term recession impulse is off the table. But hey, all those people who pulled forward their spending, they're saving now, right? Like, I think about myself personally, obviously anecdata, but like with the spending cuts coming on and the grants being lost, like my wife's work hours are going to be cut in half because her company gets grants for the work they do. She works with autistic children. And so what is that going to do to our family spending? We're going to lower our spending moving forward. Also doesn't help that we have a kid on the way, so having a kid coming while there's less spending in, it's a fun thing to consider. But I'm sure there are other families like us who face uncertainty over their future labor prospects, and as a result, they get the things done now, and then they start to stockpile for a little while and see what comes of the future. Better to save for a rainy day than be unprepared if the floods come in.
First of all, congratulations, Chris. Second of all,
baby boy, October.
As soon as you said you're shopping for a new car, and I accidentally said it on air, I go, "What are you having a kid?"
And I hadn't told you yet. And I hadn't told you.
I know.
You figured that out.
Inappropriate question to ask you on the air. I like right away. I wanted to take it back from the air and put it back in my mouth.
You know what's funny about that though? When we did our first scan, the doctor goes, "Yeah, I think there might be 2 in here." Her and I were like going from 1 to 3. What? Yeah, they were like, So when we got the confirmation this week, it's vanishing twin, which actually, I ate my twin in the womb, so I've been told, and so now my son will have eaten his twin in the womb.
Survivor. Congratulations.
Just like daddy.
Congratulations. I like where you went on the vol term structure. I don't know that you can't do. I wouldn't want to sell back month vol, but the only thing you could do is really just not necessarily be a vol seller in the front month, which is probably blasphemy for most of the tasty traders here. But I thought, like I said this morning, I don't know that I'm getting a cheap price at 17.50 or wherever we were in vol this morning, but I'm certainly not going to try to take a stab and only protect my portfolio for the potential for the potential volatility if we get to like 14 or something like this, something under the historical average. I wanted to go somewhere with you, but I'm not sure if we have enough time. We got a hard stop. We got a hard stop today at 6.
Yeah.
Is it all right? Everybody's saying congrats in the chat. Sleepy Mocha says congrats. Sub-Zero says congrats.
I'm also a big fan of the child. For future reference, now that I have more children coming in, my preference and desire to see an expanded child tax credit has nothing to do with me having another child.
Rational self-interest as a mother.
But see, I knew I would want that, which is why for years I'm like, hey, the child tax credit sounds like a nice thing I will enjoy when I have kids, so I'm going to support it now. No, I'm not a hypocrite asking for it. I was always for it. It just happens to benefit me now.
What do you think about Bitcoin here, man?
I think the Bitcoin news over the past day is, kind of laughable. MicroStrategy,
referring to
GME, GameStop adding Bitcoin
to
balance sheet, an unlimited supply. How should I put this? I don't own GameStop, but being a long-time Eli
have fun saying poor.
Yeah, I know. I bought all this Eli Lilly at around $88 a share. I'm really struggling out here. Okay. So like I think about Eli Lilly. Okay. If Eli Lilly, which makes these GLP-1 drugs, fat shots, if they were to come out tomorrow and say, we're going to use our excess cash flow to invest in Bitcoin, I would say, holy shit, they have no innovation left in the pipeline. They have no more good ideas. The best use of their capital is to speculate on a financial instrument. These guys have no idea what they're doing anymore for the long-term health of the company. It is pure financial engineering, right? It's not related to the underlying product. It's not related to the underlying service or business itself. If I'm a GameStop investor and I invest in this company, am I investing it because of the Bitcoin? Right? What does the Bitcoin do to help console sales, to help hard physical media sales, to get people like me back in the store so I stop buying digitally and I actually go in person again? I'm a gamer, right? So what are they doing for me? Nothing. And the world is increasingly digitized. I understand the idea, and I'm certainly adherent to it. If I really want something, I make sure I have a physical copy of my own. I don't download it and buy it and keep it in my like Xbox Game Store or wherever movies app, right? Because if they strip the license from me, that's it. I paid for a license I no longer have access to. But GameStop, what are they doing to get more people in the store, to buy more of their products? The way that Microsoft and Sony conduct their business online is a long-term death knell to a company like GameStop. So I see a Bitcoin as like a far-flung, we got to do something to pump the stock price. Hopefully this draws people in. Long-term, nothing good. Nothing good. Now, Bitcoin itself, look, we have a USD1 stablecoin thanks to the White House now. Over the weekend, we had a tweet from the president.
That's an embarrassment. Like, I looked at that and I go, it's backed by dollars, treasuries, and cash equivalents. And I go, what? Do you not understand the problem we're in right now? Those are nothing. That's nothing. You can make as many of those as you want to. There is no underlying collateral there. This is we're in we're in just a clown world right now. And since you're backing it by this stupid fucking pieces of paper that you can print a bunch of, it's like,
did you hear something though?
Get the problem.
That is exactly why I don't understand why Trump is so worked up about the trade deficit. The trade is you give us real, tangible, physical things, and we give you pieces of paper that we can print infinity of. And people are like, yeah, we'll take those for our junk. And we're like, okay, we'll take your cars and we'll take your refrigerators and we'll take your this. And you keep these magical pieces of paper that we can dilute until you are worth less at any point in time. And they go, oh, thank you, sir. It's so good to be under the umbrella of the American empire.
Mm-hmm. that was sort of the initial thought. For globalism, and just the problem is, the problem is the societal cohesion. The benefit hasn't been evenly or even close to evenly distributed, and now the inequality issue has come home problems.
Can you look up the elephant income graph? Right, that is the whole problem that we're having right now as a society in the Western world. As we've globalized from the late 70s onwards, it starts with Carter, right? Everyone hates Jimmy Carter, by the way. You don't have any craft brew beer without Jimmy Carter. Jimmy Carter allowed that to be legalized. One of the many good things that Jimmy Carter did. Generally a good person. So Jimmy Carter starts neoliberalism off, the deindustrialization of America, if you will. Reagan and Thatcher accelerate it. Clinton accelerates it. Bush accelerates it. Obama doesn't really do anything to stop it. Trump starts to turn the corner. Biden actually does a really good job of bringing back a ton of construction and manufacturing jobs, all this capex investment. We're going to see if it continues with Trump, and Trump is clearly trying to take this momentum and get it going for him. But this, if you look at the income graph here over the past 40 years, what we've seen is that the income distribution for the wealthiest people on the planet has gone up. The income distribution for like the 40th and 60th deciles has gone up, but the people in the 80th decile have not increased whatsoever. And why? Who are those people? Those are middle-class people in the Western world. Those are your Americans. Those are your Brits. Those are your French, your Italians, your Germans, your Canadians, your Japanese, your South Koreans, who work not white collar jobs, but they're working class people. And that definition shifts over time, right? The working class today is not in my head, when I think of a working class person, I don't think of someone who's hammering away on an assembly line here in America. I think of the person who's like a teacher. I think of the person who's working a gig job, who's driving an Uber, who's, working in a storefront, who's a delivery guy, right? It's other people's perception is different of what working class is in America these days. But the Barbara Ehrenreich Nickel and Dime book kind of gets to that now too. Working class America is really a service industry these days. And I think Trump wants to bring that back to manufacturing. And there's a good point to that. You can't protect yourself unless you have a manufacturing base. And since World War II, the U.S. and its allies have gone from being both 50% or more of global GDP and 50% more of global manufacturing to below 50% of global manufacturing, and now we're like 51% of global GDP. You only can set the rules of the road if you have one of those two things, and China might have both soon. So there has to be a course correct. If we continue along the path that we've done since 1980, our allies and our network, we have a plurality globally, but we are no longer the majority. And that's a different system. And so I think that's a system worth protecting still. Genuinely.
I agree with you 100%.
I told you.
I
no American empire ending in my lifetime. Save that for the grandkids. That's going to suck.
I think it's wishful thinking at this point. Real quick, as a response to something you said, Eli Lilly puts Bitcoin in the balance sheet. That would make you think that they have nothing in the pipeline. There's a lack of innovation there. I wouldn't be, me personally, I wouldn't be so quick to think that way. And I'll tell you why in 30 seconds or less.
Sure.
If we're already running these high deficits as a percentage of GDP and we're only looking at growth scares, if you can see a world where we get into a bona fide recession, whether mild or not, the spending impulse for the U.S. government, the fiscal authorities, has always been to increase spending at that time. Now, if you can imagine, you thought you were going to be in a world of perhaps decreased government spending and perhaps more fiscal responsibility, and all of a sudden you find yourself in a world where you're just exploding the debt at similar levels to a previous administration, if not more. People are going to look at ways to protect their purchasing power, and they're going to look at a load of cash on their balance sheets, and investors are going to go, what the hell are you doing? That stuff is eroding at this massive rate. And I'm not saying all companies will do this, and I'm not saying it's a smart move, but I can guarantee you, if we keep devaluing at the rate we are, you're seeing this at the state level, and it wouldn't surprise me to continue to see it at the corporate level, man. It would not surprise me at all. And I don't know that I would look at that as anything other than somebody reaching for an asset to try to protect against minimization of purchasing power. Chris Vecchio, I thoroughly enjoyed this conversation today. I thoroughly enjoyed the challenge and your perspective, which in many cases might have differed than my own, but a respectful conversation nonetheless. Chris Vecchio, if the people want more from you, and I think you've given them zero reasons not to want more from you today, can you tell them where they can go?
Leave me alone the rest of today. But you can find me on Twitter at CVecchioFX, here on Tasty Live, Monday through Friday, Futures Power Hour, 1 p.m. Eastern, 12 Central Time. Monday through Thursday, overtime, 4 p.m. Eastern, 3 Central, right after Last Call. Speaking of Last Call, I'm on this entire week with Tom, so be sure to join us at 3:30 Eastern, 2:30 Central. Let Me Explain Tuesday mornings, 9:40 a.m. Eastern with Tom and Tony, and then with Victor on Wednesdays for Wacky Wednesday. Victor, you told me it's Wacky Wednesday. I came here with the jokes to start. I try to get a little bit serious at the end. I'm looking forward to our typical Wednesday conversation after this. So you're waking up. I'm winding down. I have a few beers. You're having some coffee. I'll catch you on the text chain in a little while.
Sounds good. Brian Watson said, I bet Chris gets a Porsche Cayenne. Don't do it, Chris. Don't do it.
Okay, real talk. I really like the Lexus TX, the new one. But I was looking up the information about where it's built, and it's like, hold on, you're built in Indiana. You're built in Indiana at the same factory as the Grand Highlander Hybrid. That's a Toyota.
Correct.
It's the same exact wheelbase.
They are.
Same exact everything except for the outside of the car is wrapped right with an L on the front. And it's like, that's $12,000 less.
But that's you could look at almost every car brand and their sort of their stat.
Well,
and
Toyota.
Very similar in many.
Toyota's unique. Toyota, like the only thing you need to worry about with the Toyota is changing your oil, right? It's such a well-made car. So Lexus or Toyota, I think, is where I'm going to be at.
I pulled up to a billionaire investor. He was a previous investor in one of the companies.
Tom Sosnoff?
No, a different one. Okay. And I
look at you, 2 billionaires.
I was driving a car, and he was driving a less expensive car. And nothing, in that moment, I realized everything that was wrong with the way I thought about money and the way I made purchases. And I completely changed my entire life after that moment. So I know you don't need to be told this, but man, buy a good used car, and who gives a about that brand, and put all that money in a compounding asset away for those beautiful kids of yours. Not that you need financial advice from me, Chris. I really enjoyed this conversation, man. Hope you have a great night.
Cheers.
Take it easy, and for the rest of you, do me a favor while Chris gets out of here. Do me a favor, hit the like button, subscribe to the channel if you hadn't already. And you feel free to follow me on Twitter if you want, at Victor Jones. The Owen Jones is 0, because I like to be difficult. If you want to hear smatterings of a madman from time to time. As I said before, not a bunch of changes from me, other than buying a little bit of long vol this morning. I know I could very well miss the turn here by not necessarily going short. And we could have a washout down to below that previous value area at 5,500. I know that could be the case. I'm just not convinced. At 1 day of vol at the technical resistance area, I think there's probably still a decent amount of demand. And so I don't know. I don't think they want this thing to get running too fast to the downside. I think you've got a ton of, there's this great podcast. I'll leave you with this. There's this great podcast I watched the other day. It's a podcast called What is Money by Robert Breedlove, I think. But the specific podcast had a gentleman named Mel Madison, who's a really, really smart guy. And in it, he talked about the fiscal authorities lining up a bunch of inflationary forces on one side and deflationary forces on the other. And I thought it was the exact right way to think about the world that we're in right now. I thought at one point in time, that's exactly what the Fed was trying to do during their 2021, 2022, 2023 period, which was line up the risks and the fears of the inflationary risks and the deflationary risks. And though there was a wide distribution, they needed to keep those risks balanced. And I see this administration trying to do the same, though they're not managing vol well. There's a lot of vol coming into equity markets pretty quickly, though I would make the case that bond markets and credit markets are fairly settled. And if that's the case, then maybe they're not so afraid of equity vol, but equity vol can turn into credit vol pretty quick. Anyways, my point is I'm still in a sideways choppy market. That's the way I'm playing it. I'm not going straight short here. I'll leave you with that. So I will see you tomorrow, same place, same great network, only on Tasty Live. Peace.